Assalamualaikum and good morning, everyone. Okay, welcome to today's workshop jointly organized with the MIA, MICPA and also CANS. So, as again, my name is Hassan Ismail from the Competency Development and Framework Department. I will be hosting for today. For information, this is the second Train the Trainers that workshop that we jointly organized with MIA, MICPA and also CANS, exclusively designed for the accounting lecturers. I would like to thank everyone for attending this session, and we hope this session will benefit all of you as well as students. And today we have more than 200 academics has joined the webinar today, all right? And basically we received more than 200 registration from the lecturers. For information, the Train the Trainer workshop is part of the initiative of the MIA and also professional bodies to enhance the capacity of the academics and to ensure that the academicians are updated to the latest changes of the accounting standard, rules, regulation that related to the accounting education and also professional. This is a platform whereby the practitioners and also industry, they can share their experience and knowledge to the academicians and to update the latest changes happening in industry. The information and the knowledge will be useful for the teaching and learning activities with the students. So for today, our speaker will be discussing on the periodic revision of the international standards on auditing, which are critical and also important in ensuring that all practices remain robust, consistent, also aligned with the evolving global standards. The ISA are important in maintaining the credibility and also reliability of the financial reporting, which is in turn supports the integrity of the global financial system. Okay, perhaps before we move to the main agenda for today, we will start this session with some updates from the MIA and as well of the MICPA, right? So for today, from the MIA, that we would like to share some updates in terms of the new development at the MIA. If you're aware that MIA have a launch on the sustainability blueprint, all right, and this sustainability is a new agenda, and I think it's a new thing happening across in the world. So we would like to share with all the communication. You can download on the sustainability blueprint at the MI website. Okay, you can go to directly to the sustainability area to look into what kind of the sustainability that can be related to your area. And also MIA and also the Education Board, we will conduct a survey to the all academician. All right, this survey is particularly want to know and to understand on the current syllabus of university, and then we will share and to update and to embed some of the sustainability element into the education into the syllabus. So we will share to the all academician in the course one is ready, and we would appreciate if all the lecturers you can participate into the survey. All right, this is in order to for us to understand what kind of support and also what kind of the information that you need for MIA in order for you to enhance on the syllabus and how to embed on this sensibility. And the next update is I want to share with MIA about the on the MIA YouTube channel. So if you look directly to the MIA YouTube channel, we do have a few of the videos for the teaching and purposes and also advocating members. This is applicable to all right, not only to members, and it's open to the public, all right. And in the MI YouTube also, we do upload on the Train the Trainers video that we have conducted before. There are some from the physical event and also some are from the virtual event. This is for you and also to benefit those who are unable to join the session, and you can look at the video for the teaching and learning purposes, and also you can share. You can share with the students as well, all right? Then let me proceed to the next update. Okay, maybe I can recap a bit. This is on the sensitivity agenda, all right? And then the also the blueprint that we uploaded at the website for you reading, all right? And then on the MIA YouTube channel, whereby we provide the advocacy videos, all right? And also there are also plenty of the Train the Trainers. You can directly search for the Train the Trainers. There are a few of the videos that we have been uploaded in YouTube. And for today's session also, we'll be recording the session and we will upload the video at the MIA YouTube as well. All right, the next update that I want to share about the MI accountancy framework, I believe that most of you had heard on the MI accountancy framework, whereby MIA we have released back in 2020. So part of the MI accountancy framework information plan, the MIA currently developing the MIA practical relevant experience program. All right, this is a part of we enhance the current care program, whereby the requirement of the practical experience of the graduates in order for them to become a member. So what have been some changes and been updated is in the current MPrep program. Okay, some changes involved is in terms of duration. If you're aware that currently for graduates, if they want to become the MI member, the minimum duration that MI accept is 6 months of the employment. However, going forward, the minimum duration that MI accept is 3 months. Okay, so 3 months, and the duration for the minimum requirement is 3 years is maintained the same, and it should be completed within the rolling period of this 60 months, meaning that 5 years. Okay. Another changes the changes that we made also in terms of the approved training organization. Current care program, we don't have the ATO, but moving forward, we will introduce the approved training organization. This is to assist the graduate and also the mentee for them to find the company, or also for the training purposes that would be planned training for them to achieve on the required competency of the working experience. And then lastly, in terms of the technical and engineering competency, this is a important component whereby the technical and engineering competency that have been updated is actually is in line with the international education standard on the technical competency. So there will be 8 technical competency, and the new area that we have introduced is on the advisory function and also the business strategy and management. This is a part of the new update, all right? And on the generic competency, so in the 3 years working experience, they require 2 competency, technical and generic, for the mentee or for them to comply. And the big changes happen will be on generic competency. This is consistent with the IAS 3 and 4, all right? And then whereby there will be a new skill set requirement, for example, on the intellectual skill, interpersonal and communication. And this skill set actually is important based on the feedback received from the employer and the market need as well. Okay. Okay, next, I would like to share some updates on the membership itself. So if you're aware that MIA, we have 2 membership category. One is on the chartered accountant, and one is the other one is associate member. Chartered accountant is mainly for those with the experience in the industry, whereas associate member is especially membership category we provide for the academician. I mean, that's if the graduate, they are doing teaching with that experience, they can apply as associate member. So this is the statistic of the membership employment. So up to the February, we have about 2.13% of the members are from the academia sector, right? So some of you is falling under this area. And then just a little bit sharing on the how actually for you to register for chartered accountant in Malaysia. So basically currently MIA, we have a 3 pathway. Okay. First one is on those who are graduate from the recognized university. They have to undergo the MIA care program for the record of the 3 years practical experience before they can become the chartered accountant. And second pathway, if those with the professional qualification, all right, recognized accounting body program. So once they become a full member of the recognized body, can register as a chartered accountant. And the last pathway is those who are graduate from the recognized university or any accounting program. They need to sit for the MIA qualifying exam. And then with the 3 years of the working experience, they need to be fulfilled and monitored by the CAP program before can become the MIA chartered accountant. This is the same pathway that we have currently. Okay. And the list of university, it is a list of university that currently recognized by MIA. Okay, at the moment we have 21 university that have been recognized under the MIA under the part 1. And under the second pathway is on the recognized professional body, whereby this is the list of the professional body that recognized by MIA. So MICPA, CANS also is part of the body that we recognize by MIA. And the last one is on the how to apply as a member. I think this is more relevant to the academics, and I'm not sure how many of you are yet to become the MI members. So if let's say you don't have any experience in the industry, you can apply as an associate member. So this is part of the route that we have for the associate member. So the requirement is if you possess a first degree or master or higher, and you have not less than 3 years of teaching experience, you can apply as a chartered accountant. Okay, so how to apply? You can directly go to the MIA member services portal. Okay, so for the first time, you can click don't have an account to register, and then in the for the associate member, this is the record that you have to complete. Okay, on the RTE. For those applying for chartered accountant, they have to fulfill the technical and competency and the CAD, whereas for academics, you only have to fill up the record of teaching experience. Okay, so this is only applicable for commission wish to apply associate member only and to support the 3 years experience, and this must be submitted with the application form, and it must be verified and signed by your immediate superior. So this is how actually record of teaching experience look like. So you will list on the subject that you will teaching, and this information actually available at my website. Next, can we move? I will actually invite MICPA team, all right, to share some updates with the participants. Can you invite Mr. Gilbert?
Hi, good morning, Hasmida. Can you
Yeah.
hear me?
Yeah,
All
now
right,
can hear
okay.
you. Okay, I pass over to you.
Thanks, Hasmida. All right, once again, good morning to everyone, and Salam Ramadan to all our Muslim lecturers here joining us. Thank you for joining us. And allow me to quickly bring you guys through about the program that we're offering. Yeah, and then some updates on our program, and then how it will be benefit to the students who want to embarking or to consider professional qualifications under MICPA and CANS. Yeah, I believe most of you most of the universities who are joining here is actually be accredited by MICPA. If you have not, all right, if you're if you guys keen to look into we are more than happy to have a courtesy visit and see what kind of possible collaboration that we can have, right? And then without further ado, allow me to quickly bring into the program that we are offering and why MICPA CANS, right? As you are aware that Malaysia is an open market in terms of accountancy professional qualification, there will be a lot of program offering in Malaysia for accounting students, right? And why MICPA CANS? First of all, of course, our title is actually globally recognized. In fact, we are the one of the founding member of IFAC back in 1977, right? So this is the point that bring it to a lot of the I would say the market, they have a misconception that MICPA is being a national body and local brand is only recognized in Malaysia, but it's not overseas. Essentially, it's a misperception. In fact, we have quite a numbers of our members holding the Certified Public Accountant Malaysia title, all right, working abroad. Yeah. And the next thing, the next key point that we want to bring to you, the attention to you, is actually access to global Accounting Alliance, which this GAA is actually the 10th premium body in the world across the 12 countries. Who are they? Yeah, of course, under the GAA umbrella, I would say, or this alliance, we have CPA Canada, yeah, on the most left-hand side, and we have AICPA from US, yeah, and then we have CA Ireland, CA Scotland, ICAW, IDW Germany, we have CA South Africa, we have CPA Hong Kong, JICPA from Japan, of course, and our partner CA ANZ, Australia, New Zealand, and Malaysia. So with this GA passport, students are able to go abroad and to be supported by the professional body in that particular country. And all these 10 premium body, they're actually supporting every one of us, whoever in that particular home country. With an example, right? If we have someone from JICPA, they're coming over to Malaysia for a business trip, they need a local tax law support. They will drop us an email, all right? Drop MICPA an email. MICPA will supporting them accordingly with the needs that are as a member. No additional fees required. Yeah. And the other thing is actually it's a dual qualification for the program that we're offering here, right? End of the day, students are going to have 2 qualifications, one from MICPA, the other one from Chartered Accountant Australia and New Zealand. And students will be going to hold 2 titles automatically. which is Certified Public Accountant Malaysia, as well as Chartered Accountant Australia and New Zealand. With this pathway, our students will normally have access to MIA and register under the members of MIA. Then they were getting the third, designation called Chartered Accountant Malaysia. So right, with one program, we're going to channel you out for 2 qualifications, and ultimately you will be having 3 designations: Certified Public Accountant Malaysia, Chartered Accountant Australia, New Zealand, as well as Chartered Accountant Malaysia. Right? This is most of our students who are holding the 3 titles in one program. And of course, the differentiation between the program, I would say, is very unique. This program is actually identical program between Malaysia, Australia, and New Zealand. The difference is actually the local context and relevancy, where one of the subjects in the program itself is actually tax, so that for all the students who are taking this program in Malaysia, right, they're going to take Malaysian tax. That's why we localize the program into our local variants, and then of course the tax and law will be covering under the Malaysian variants. So this is the uniqueness of the program itself. Yeah, and I will probably share with you, I would say over 95% of our students actually been employed. The mobility is actually very high. Reason being is actually, we actually do assist students, our students, into the employment opportunity. Reason being is actually this program is actually mentoring program. Yeah, not only we're mentoring in terms of their studies, yeah, as well as the 3-year practical experience, where we're going to assign a mentor, which under the accounting firm or even commercial, there will be a mentor guiding our students through 3 years to develop with the right skill sets. All right, in the 3-year practical experience, it's something very similar what Hasmida has been presented earlier on, so that we have 10 technical competencies. Students are required to complete at least 2. One is major, the other one is minor, and of course, non-competency area, there will be a list of them to fulfill within the 3 years, so that students are required to required to fulfill the technical competency for at least 1 major and 1 minor before they are allowed to admit into a membership of MICPA, as well as Chartered Accountant Australia, New Zealand. So this is the program all about, that where how are we going to shape our students from the beginning right until the 3-year practical experience and admit into member. Yeah, and this is the pathway that we're offering. Of course, we do recognize diploma in accounting. And then those diploma accounting graduates that are eligible to go into professional state examination. It's a closed book exam, 4 modules, right? And then subsequently, they can go to our advanced state examination. Alternatively, those universities' degree being accredited by MICPA, right? Your degree, let's say you've gotten full exemption from the professional state examinations, you will be straight away go into advanced state examination, where this is a program that is mentoring program, it's open book assessment, and then it's actually collaboration with CA ANZ. Yeah, and with 3-year practical experience, you are going to get the 2 memberships, and subsequently we'll get you into the MIA. Then the 3rd membership will be coming in. Of course, other than diploma and degree, we also have students who are from non-academic graduates. Yeah, we do have quite a number of science students and law students coming to us, and then they're going to start out with our MICPA conversion program, and subsequently proceed with our ASE and be getting a membership as well. Right, this is some updates. Yeah, so that look at the program that we're offering. MICPA CANS qualifying program. This is a program structures. Yes, we have 8 subjects. All right. In terms of number of subjects, yes, I would say that we have one of the most subject in among the professional body. But look at carefully, right? The number of subjects actually doesn't determine how tough or how long the student can complete. If you complete this program in a full-time basis, basically you can also complete in a year. Reason being is actually like ethics and business is only 2 weekends. Yeah, so that is something very it's 100% coursework. So that is actually we shape our students start off with ethics. And then we started with the teamwork, all right, collaborations, communications, and presentation. Start off with core 1, and we're going to carry on with other subjects. Only carry for 8 weeks, except our text. The core 4 text MY carries for 14 weeks. Text MY here is actually the most heavier subject among our in this program among the subject itself. All right, as good as heavy as the subject that lecturers conducting in the uni, 14 weeks. Yeah. And then, of course, we have a long list of elective. We have assurance, and one of the very popular is actually data analytics and insight. All right, financial modeling, advanced financial reporting, as well as sustainability for accountants. Also, another very popular elective that we have. So that students are required to complete all the core 1 to core 7. right? And one elective. In order for you to complete this program, you need to go choose one elective, right? So that this is the program structure we have at the moment. And then it's a revamped program structure. And this program actually will be running in Malaysia or with MICPA for the past 3 years. We actually launched it in 2022. It's a revamped program structure. And along the journey, we do update the content. And then allow me to share with you the core 2 and core 5 that I'm circling it. All right. In the past, for core 2, it's actually risk and technology. Also another 100% coursework subject. But in this coming June onwards, we actually expanded the AI component into one of the chapters there, one of the chapters of the core 2, so that with a better reflection of the title, we will name it as a risk, technology, and AI. All right, so that there will be a quite comprehensive AI topics into these chapters as well. So that this is the survey that we have done in the past 1 year, so that what markets is needed for the AI knowledge for the students, so that we embark all that knowledge is required for students, so that those students who went through this program should be able to meet the expectation for the industry, especially for accounting firm. Yeah, and the other one will be core 5, strategy and business performance. In the past, we call it business performance. And then we have one elective course, strategy and performance, so that we merge the two into one, so that, to align the learning progress between strategy and business performance, so that we actually merge it into one, so that this is later development for the core 2 and core 5. And bear in mind, core 2 and core 5 is 100% coursework. Yeah. So basically, our ed subject is actually 4 100% coursework based subject. Right, we have our ethics and business, 100% coursework, only 2 weekends, read up with presentation. Yeah, and risk, technology, and AI is actually 2 written assignment. Strategy and business performance, also 2 written assignment with 1 workshop contributions. Yeah, and any elective that we're offering, only 6 weeks. Yeah, also with 1 assignment and presentations. Okay, whereas the 4 subject with exam based, we have financial accounting and reporting. Yeah. And then we have taxation MY, which is core 4. We have audit and risk core 6 as well in the ICAP, integrated chartered accounting practice. Yeah, this 4 subject with exam based is not 100% exam. Yeah, we have 40% written assignment, and exam component only 60%. And our exam is actually 2 hours and 50 minutes. That's why how are we shaping, and everything will be online basis, and share with you the passing rate. For the past 3 years, it's actually 81% as averagely. Yeah. So this program, again, the student can take it full-time basis or part-time basis. If full-time basis, you can basically complete in a year. All right. Of course, we are giving you 8 years to complete, but a student nowadays, they might want to take a shorter way to complete, so that a lot of students will come into full-time. They complete a year, then only start embarking into the employment. Yeah, and this is the platform I'm going to share with you that our students are using for this program, and it's very advanced and it's very handy.
Technology is impacting accounting practices in new and exciting ways. At Chartered Accountants, we know our members want to grow their capabilities and future-proof their careers in parallel with this changing landscape. We want to help them on that journey and set them up on the right path for the future. 3 years ago, we set out on a journey to evolve our program. We listened to our members and candidates, and they told us they wanted flexibility, relevance, and choice in their studies. The new CA program stays ahead of the changing accounting profession and offers greater choice, flexibility, and support for candidates and their employers. The new CA program offers authentic learning experiences via case studies that mirror real-life scenarios. They're designed to encourage critical thinking and help candidates practice and refine their professional judgment. The completely digital interface is intuitive, interactive, and easy to navigate, while the success secrets of real-life CAs provide tips and tricks to complement the content. The new CA program's My Capability Learn provides candidates with a holistic overview of the subjects they're enrolled in. It is designed to promote a flexible and interactive way to build skills, engage with subject content, and connect with peers through discussion forums and live workshops. The new CA program's interactive digital study guide is designed to complement candidates' preferences for flexible learning while upholding our commitment to environmental sustainability. We've partnered with Wiley and Vital Source, so the study guide is linked directly from within subjects. Candidates can learn whenever, wherever and however they want via a range of helpful features and language functionalities such as read aloud. The study guide is accessible to candidates in online exams, so they can see both the text and the notes they've made. It can be synced across up to 5 devices, so it can be used on the go. We've designed the new CA program to better connect candidates to their peers and industry and meet them where, when, and how they like to learn. The future is here, so discover the possibilities today.
Right, this is the platform that our student is using. So that basically everything will be on the platform itself, so that we do not have any physical textbook or study guide or any partial question in hand, right? Everything will be in the platform and everything will be very handy. Even the submission of assignment or even exam will be everything in the platform itself, so that we do not worry where our students are. And then we have no more exam center, right? Since 2020 onwards, all will go online, and then everything will be in the platform itself, so that students actually study, all right? And then they can do their short notes, they highlight everything, do their flashcard, everything in the study guide itself, and during exam, they can just flip through. Yeah, just for your information, our exam is all open book exam for all our advanced examinations. Right. Some updates on the latest development from the institute itself, so that we have launched our MICPA provisional studentships. Yeah. So some of the university, when that we have a so-called courtesy visit, we actually share with you guys, so that we actually encourage students, whoever's interested with MICPA and CANS program, yeah, they can scan through this QR code, and then students are getting a waiver for student registration fee, you know, and then all the updates, so that we're not forcing students to do the scanning. Only those students who are really interested, so that we'll be getting them to be prepare them for the to enroll them into the program itself, so that we'll keep giving them an update. There will be an event for the students, then the newsletters and all the updates, and even sponsorships available will be informing through this platform itself. Yeah. And we have also MICPA Student Counselor Program for the intake 2025 and 2026. Some of the universities that get to be touch base, if you're interested, do let us know, so that we are more than happy to touch base with you guys and actually work with your student, and then inviting your student to be a student counselor, so that we'll be selecting few reps from each universities, and then become a MICPA student counselor, and then we will be giving, we'll be supporting the student and train the student become the next leader. Yeah. And Accountancy Week for 2025. This is one of the so-called major events in our institute for all the students, right? Will be happening on the 22nd to 26th April. And this year, we're actually collaborating with UKM. Last year with IIUM, this year with UKM. So that every year we actually, going to collaborate with all the university by university, so that we have a lot of activities. Do encourage a student to join us, yeah, so that we're going to wrap up everything on the 26th April, which is on Saturday, with all the sports games happen in UKM campus, yeah, so that hope to see you guys in this coming Accountancy Week. All right, in summary, yeah, with the program aligned with the mentor practical experience with the mentoringships, so that students are able to admit themselves, become certified public accountant and chartered accountant Australia, New Zealand. Of course, access to MI membership, so they gotten, as I mentioned, they will be getting a membership of MIA, where they got the designation of chartered accountant Malaysia. Other than that, they can apply with the membership itself. They can apply audit license, okay? And then our membership also recognized by ISDN, become a tax agent, and also recognized by SSM. Then you can register yourself as a company secretary, as well as insolvency practitioners. Yeah. So that other than that, nothing much. And then this is our contact. If anything you want to know more about, want to explore, want to reach out to us, do feel free to reach out to MICPA. Thank you very much.
So let me proceed to our main agenda today in for the our webinar on the main topic. Okay, before I pass to our speaker today, let me share a brief information about our speaker today. We are very honored to have our beloved speaker is Mr. Khoon Yeow, the partner of the Learning and Professional Development at the BDO Malaysia. Mr. Khoon Yeow started his career in 2002 with the Audit and also Assurance Division of BDO before his involvement in the Learning and Professional Development services since 2006. His current responsibility includes facilitating International Financial Reporting Standard, FRS, and also auditing training courses for both professional staff and also client of BDO in the Southeast Asia region. And Mr. Khoon Yeow, he's currently an executive in residence for the Sunway University Business School, a member of the External Advisory Committee for the Department of Accounting at Sunway Business School, and a member of the Academic and Industry Advisor for the Sunway College Diploma in Accounting Program. Khoon Yeow is a chairman of the BDO Asia Pacific FRS Group and a member of the BDO International FRS Policy Committee, BDO International Sustainability Reporting PC, Global Audit Training Advisory Group, Common Letter Task Force, and Ethics and Independent Standard User Group. He also a member of the Ethics Standard Board and also the Accreditation Board of MIA. So for today, Mr. Khoon Yeow will share and focus on the 3 key international standards on auditing on the ISA 600, Special Consideration Audits of Group Financial Statement, ISA 305, Identifying and Assessing the Risk of the Management Statement, and ISA 540 on Auditing and Accounting Estimates and Related Disclosure. So these standards are essential to ensure that audits are conducted with the highest level of professionalism and also consistency, and providing confidence to stakeholders in the accuracy of financial report. So we look forward to session that filled with valuable insight into this important topic. All right, I do hope that all participants to grab this opportunity, okay, for you to ask our speaker any question. All right, so like before, without further ado, like we invite our speaker to that session. Mr. Tan, are you ready?
Yeah, all right. So let's continue from here. So there are 3 simple ISAs I'm going to cover today only. 540, 315, and 600. You might be wondering why. The why is very easy. That's because these are the 3 major standards that has been issued over the last 2 to 3 years that has significant repercussion on the auditing profession. And the genesis actually begins from ISA 540 itself. If you are wondering what is that, ISA 540 deals with auditing fair value. Right, so auditing fair value is not a new standard altogether. It was previously ISA 545, for those of you who recall once upon a time. So once upon a time, we had ISA 545, and what has happened then is that we changed it. We superseded it into ISA 540, as you can see over here. And what happened then was we revised it over and over again, up to 3 to 4 years ago. And so 3 to 4 years ago, the revision was intended to do one thing. It was to do what we call test water. It was supposed to test bait to see how the profession would react and how stakeholders would react to the new thinking process of how we will perform the audit. Now, because the test water was successful, the IFAC or IAASB decided to continue with the project of revamping the way we do an audit, and that then culminated in ISA 315. So ISA 315 was then revised several times from 2019 onwards until even today. And then that finally led to one more major revision that is effective this year's audit, and that's ISA 600. So ISA 315 is a risk assessment process or risk assessment standard. ISA 600 on number 3 over there is on the group auditing. So you notice, therefore, I've laid this out sequentially so that's easier for you to follow the thought process of why these 3 standards and how these 3 standards were amended and revised so as to reflect the new thinking. All right, moving forward. Yeah. So let's just go into 540 first. So 540, remember, 540 has got to do with something called your auditing of fair value. So fair value basically is the hot topic, if you recall, from the IFRSs because of the introduction of IFRS 9, IFRS 13, and a lot more accounting standards. Now, before we had the revision, so how I'm going to do this is to do a perbandingan, contrast for you between what happened before and what happened after. All right, so before, once upon a time, before even 3 years ago, what happened was that we were already auditing fair value. It's not like we don't audit fair value. In the good old days of auditing the fair value, the requirements for an auditor was much, much easier. So what do we mean by much easier? Well, first thing first, it says that if you're an auditor, we are risk-based auditors. So as risk-based auditors, that means we are supposed to perform something called risk assessment procedures, RAPs. So if you notice that for risk assessment procedures or RAP would entail therefore an auditor always obtaining something called understanding. Let me just get my blue ink. All right, understanding. So understanding over here means you must understand, must understand what is the client all about. And to understand what the client is all about, it says, if you notice in the good old days, first, we as auditor must understand our accounting. All right, our accounting. So where's my accounting? Over here. All right, so the requirements of applicable financial reporting framework. And that was easy because in Malaysia, we only have got 2 basic standards to understand, MFRS and MPRS. So MFRS is your Malaysian Financial Reporting Standards. MPRS is your Malaysian Private Entity Reporting Standard. It was very easy, right? So we as auditors must understand in the first place what are the accounting requirements when it comes to fair value. And I've given you the standards, right? So we have got MFRS 13, for example. So MFRS 13 will teach us how to get fair value, how to calculate fair value. Standards like MFRS 9 will tell us this is how you go about accounting for the fair value of financial instruments, for instance. MFRS 15 will tell you go about to calculate the fair value of your contracts in order to determine your transaction price allocation. So there were a lot of MFRSs that tells us or uses the word fair value. Wonderful. Now, once we have understood what the MFRS and MPRS requires, then obviously the next thing we got to understand would be management. What do I mean by management? Well, management is easy. That's because auditors don't prepare financial statement, right? Common misunderstanding. A lot of people happily think auditors prepare financial statement. When something goes wrong in the accounts, blame the auditor. This is where we have to be very clear. Management prepares financial statements, right? Auditors audit the financial statement. So as an auditor, I need to understand how, in the first place, did the management come about with identifying transactions, events, and conditions. We call these TECs. All right, TECs or tags that could give rise to your accounting estimate fair value. That's it, sorry. So it's about understanding how management identifies all those TECs that gives rise to a fair value. And then after that, we understand how does the management go about with the calculation of this fair value, so to speak. I've lost control of my screen. Okay, this part. How management makes estimates and understanding of the data, right? So management is supposed to identify how they're going to calculate the fair value or even the depreciation or any kind of accounting estimate. We as auditor obtain that understanding. That leads to the question of how. How, macam mana? So the how is where we say as an auditor, we will have to open our big mouth, right? Open our big mouth means ask management. So we will inquire of the management. And so this is the one thing we always teach a lot of fresh graduates as well. As your auditor, you sit quietly in a room and you just stare at your computer, you are in trouble. So you need to go and open your mouth and ask the client fantastic questions. And then after that, you will need to perform your RAP, risk assessment procedures, at the risk management functions, methods, and practices, right? At the management's function, management's methods and practices. Sorry. So what happens is that you will need to obtain an understanding of the management's basically introduction of the term called methods, assumptions, and your data, right? So to speak. So once we have obtained this, what happens is we would need to be identifying our RMMs. So you're wondering what's RMM? So let me just get my pen, different color. RMM. So RMM stands for risk of material misstatement. We don't call it ROM because ROM can be misunderstood as marriage, registrar of marriage. So no. We call it risk of material misstatement, RMMs. So when we come to the process of first understand the client, understand the accounting standard, understand the management process of calculating the estimates including fair value, then we come to identifying what could go wrong. Right, so RMMs therefore is a process of what could go wrong. WCGW. So what could go wrong therefore means as an auditor, I will need to take one step back from the audit process and begin to ask myself questions like, what's the degree of estimation uncertainty that the management is facing? How uncertain is the accounting estimate? Because obviously we are risk-based auditor. We only focus on high risk area, right? Lower risk, we don't do so much work. Higher risk, we do more work. So higher risk therefore means that higher risk is a function of uncertainty. All right, so it's very much like what you're seeing in America today. The more uncertain you have in America, the higher the risk is in America. Same thing. In audit, the higher the uncertainty in calculating an estimate, the higher risk we as auditors will attach to it. So say, for example, the management uses straight line method to depreciate their motor vehicle over 5 years. Katakan. All right, so they depreciate their car over 5 years. That's not very uncertain. We know the cost of the motor vehicle. Just check the invoice. You know that it's already 5 years, so you take straight line some more, 100,000 ringgit divided by 5, you know it's 20,000 ringgit. That's a very low risk estimate, right? Now take another example. Let's just say the client comes about to calculate something called ECL, expected credit loss. So expected credit loss is an animal of MFRS 9. Right? And in the process of this ECL, the client uses the standard model, PD times ED times LGD. All right, your probability of default times exposure at default times your loss given default. So if you notice this, normally your exposure at default, low risk. All right, low risk. Your loss given default, normally low risk. Not difficult to calculate. But when you look at probability of default, the chances of the customer not paying you back are high risk. Because this is anybody's call, right? You wake up at 6 a.m. in the morning, 6% probability of default. You wake up at 10 o'clock in the morning, 10% probability of default. It's very uncertain, right? So when it's very uncertain, you get higher risk of assessment already. This is how we auditors do our risk assessment evaluation. Now, in the evaluation, therefore, right, there is one keyword that we auditors will always be employing, one key concept. That key concept is called auditor's judgment. All right, because obviously it's your tepuk dada tanya selera, right? Different auditor will have different kind of judgment. Now, that means, therefore, you will notice over the last 2 years as well, standards, both in ethics as well as in auditing, emphasizes on the keyword called professional judgment. Because if you notice, if you ask an audit junior, dear audit junior, please go and do a risk assessment of ECL, the audit junior will tell you everything in life is low risk. Why everything in life is low risk? Because low risk, go home 5:30 p.m. All right, no need to go and work so hard because remember I said just now, right? Lower risk, lesser work. Higher risk, more audit work. So if you ask an audit junior, what's your risk assessment of your ECL, client's ECL? They will be very incentivized to tell you low risk so that they have work-life balance. 5:30 go home, right? 5:30 p.m. Now, if you ask the audit partner, what is your risk assessment of the client's ECL? Audit partners are the ones who can go to jail. They are the ones who face penalties. So they're going to tell you very likely high risk. High risk means go home at 5:30 a.m. All right, so this is where we will tell you that no. High risk, therefore, we will need to spend more time and effort to audit that particular estimate. So this is where the standard tells us that, oh, depending on your auditor's judgment, you assign a risk, so to speak. Very much tepuk dada tanya selera. And remember, this is all something which we are doing before even the revision. Sounds logical, but if you start to think about it, you can already start to see the problems in the standard itself. Yeah. Now, to continue the journey of what we were doing once upon a time as well, right? In the process of estimating what is high uncertainty, what is significant risk, the standard only gives us 4 factors to consider. All right, 4 guidance notes sahaja, yeah? So the 4 guidance notes says, number 1, when you want to see whether something is high risk or low risk, look at the amount first. But remember, the amount that you put in the balance sheet, the amount of the P&L number that you put into the statement of profit or loss, it does not necessarily mean that it is an indicator of estimation uncertainty. So that's rule number 1. Rule number 1 is counterintuitive. Song sang. A lot of people tend to think that, hey, big amount on the balance sheet means must audit cao. All right, that used to be our thinking, right? Once upon a time before even ISA 540 was first introduced. ISA 540 rule number 1 tells us no. Materiality is a separate concept. All right, materiality is in your ISA, a separate ISA altogether. This is ISA 540. Risk tidak berkadar terus. Risk is not a function of amount. Risk and materiality is definitely not a concept. All right, wrong concept. So that's rule number 1. Rule number 2, if the estimation uncertainty is so high that a reasonable accounting estimate cannot be made, you need to ensure that you properly disclose. Now, if you think about it, this is a little bit of a problem as well. Right? Why? Because remember, if you're paying attention 10 minutes ago or 15 minutes ago, I said that auditors don't prepare financial statements. Right? It is the management that prepares financial statements. So if you have a high estimation uncertainty, all right, so much so that the accounting estimate cannot be reasonably made, then all we are doing as auditors is to tell the client, tell the preparer, hey, pergi disclose, go and disclose. Now, what happens if the client doesn't want to disclose? All right, the client says, no, I think the fair value of my property is 100 billion. It's unreasonably high. All right, but then the client tells you, I don't care. I got a property valuer that tells me it's 100 billion ringgit. So you are the auditor, you then say, okay, pergi disclose. And the client says, I don't want to disclose. I just want to say that's the number that the valuer could give to me. I don't think that's unreasonable. We have a logjam situation. In the logjam situation, this is where we auditors sangkut. We are stuck because to qualify is a little bit of a problem. Don't qualify the audit opinion, also a little bit of problem. So you can already see rule number 2 is also problematic. Rule number 3, if the estimates give rise to significant risks, obtain an understanding of the controls. So this is again a bit of a problem. Why? Think about it. Katakan, the issue just now is ECL, expected credit loss. All right, and the ECL gives rise to a significant risk. And the auditing standard says, pergilah, understand, pergilah, faham, what are the internal controls of your client? Think about it, hello, in the first place, if something has got high risk, how would controls mitigate the risk? Because quite a number of things in life cannot be controlled. Think, for example, of your ESG lah. All right, if let's just say we determine that certain areas in Malaysia is prone to flooding, significant risk, fantastic, right? It's a significant risk. How does controls help us? Right, we cannot go and tell the client, oh, because your office is located at a tempat yang sedang banjir, please change office. That doesn't work, right? That's exactly the problem you see rule number 3 in ISA 540. Understanding the controls is a requirement, but it didn't make much sense. Okay? Rule number 4. If the estimation uncertainty has doubt over the going concern of the company, then don't look at 540, look at another standard called 570. Now that made sense. That's because going concern is always another auditing standard, not under the realm or scope of ISA 540. So you got those 4 considerations or rules in the old ISA 540 as well to consider. Then after that, the old ISA 540 also tells us, so based on all these accessories, what do? We determine whether the management do the right thing or not. The management appropriately apply the requirements of IFRSs, MFRSs, or MPERS. We then have to ask ourselves, did the client also use appropriate methods? And the appropriate methods has to be applied consistently. Consistency is a very important principle for accountants and auditors. That is because even for me, I always tell everybody around me, it's better to be consistently wrong than to be consistently inconsistent. Because when you are consistently inconsistent, then confirm you are wrong. All right, so if you're consistently wrong, maybe one day you might become correct. Maybe, we do not know. If you're consistently correct, you're always correct. All right, but when you're inconsistent, then confirm you are already wrong. So auditing standards recognizes this principle. It does tell us that when your client makes an accounting estimate, katakan they use straight line method of depreciation, SLM, and then tiba-tiba they go and change to reducing balance method. When they suddenly change to reducing balance method, we should be very worried as auditor. Kenapa? What happened? Did we just change president, or did we just change something, or did the CFO wake up on the wrong side of the bed? So if there is a change, auditing standard says, check, is it correct or not? Is it appropriate to change or not? Okay, can so far? So I hope you can follow so far. So once you have done this under the old ISA 540, the standard then tells us very easy. After you already faham, you done your testing of controls, you check to make sure that the client has a conform to the accounting standards. They didn't suka hati change their method. Then you will perform your own audit procedure. So example, audit procedure is where you go and use subsequent event. All right, subsequent event. You use event after the balance sheet date, up to the date you sign your audit report to confirm the appropriateness of the estimate. All right, for example, you're talking of, let's just say, IAS 2. So what's IAS 2? IAS 2 is on inventory. In inventory, there is a rule called lower of cost and NRV. All right, lower of cost and NRV. So what do we do? Very easy. We go and find a sales invoice after the balance sheet date. Because we only sign accounts in March or April. So if it's December 2024 year end, we will find a sales invoice in January 2025, February 2025, March 2025. We want to see whether the selling price of the same goods is higher or lower than the cost of the stocks inventory. This is what we mean by subsequent event. Okay. Now another method ISA 540 tells us is go and test how the client management made that estimate. Test the data, test the estimate. All right. And so that means we become a little bit like the client. We change our hat. We throw away our hat as an auditor for a while. And then we apply the management hat to re-perform. All right, so this is re-perform. Buat semula. So when we buat semula, the idea here is if I use the same method, I use the same data from the client, I campur aduk the data into the method, I should get the same answer as the client. All right, say for example, the client recognizes revenue from their rental income. Rental per month is RM100. Katakan, so rental per month is 100. So what the client do? They say 12 months in a year to get revenue 1,200 ringgit. So what do? We auditor, we buat semula, re-perform. Take 100 times 12, do I get 1,200 ringgit? Right, so that is the second method. Second audit procedure. Now, the third audit procedure is to do something called test of controls, TOCs, right? TOCs. Now, remember in the earlier slide, we were saying that if it is significant risk, significant uncertainty, go and understand the client's internal control. Now, we will need to test that control. Now, what's the problem with test of control? Two things. One, test of control in ISAS is not compulsory. Bukan paksa rela. This is sukarela. You suka, you buat. Tak suka, don't do. Jangan buat. Very simple. First rule. Second rule is it depends on the client's strength. So what do you mean by client strength? Well, in a lot of PLCs, they will have control. Boleh lah test. Right? Can test, right? Because PLC clients have control. PLC clients don't have control, cannot be listed company. Very simple. But when you audit the SMEs, small and medium entities in Malaysia, problem lah. Because can you imagine, you go to the nasi lemak seller and you tell the nasi lemak seller, I nak test you punya internal control. Not only the auditor will pengsan, the nasi lemak seller will also pengsan. All right, because nasi lemak seller will tell you no internal control. All right, so the third audit procedure here is a bit of a problem, but it was in the old standard, right? It says go and do test of control. So people are like, how to do test of control? It's not easy, circumstantial as we call it. The fourth method is what I call Sherlock Holmes. Like Sherlock Holmes, Sherlock Holmes. So this is fun. Why fun? Because we're auditor, ma. So as an auditor, we are saying, I don't use subsequent event. I don't want to follow management punya method. The client got no internal control, so I don't want to test the client's internal controls for whatever reason. I want to do my own estimate. Buat auditor punya estimate, buat sendiri. DIY, you call it DIY. Do it yourself. So I don't want to know about the client's whatever straight line method of the depreciation. I don't want to know. I will go and figure out cari-cari sendiri. How will I depreciate a motor vehicle in Malaysia? So I will go and carilah, research how the competitors in the industry prepare their depreciation. I will go and find out from overseas how companies in this industry overseas do their depreciation. Then I will calculate myself and then compare it to the client's estimate. So the fourth method is Sherlock Holmes. Buat sendiri, do it yourself. So this is what the old ISA 540 will tell us to do as an auditor, right? Now, once we have done this, what do? We will have to evaluate again. Evaluate means what? Evaluate means we have our own calculation already, our own procedures with a result. We will then have to compare. Compare what? Compare auditor versus management. Now, when we compare auditor versus management, there will always be a difference, right? Auditor versus management. There will always be a difference. If there is no difference, then it is called tipu-tipu, cheating. Cheating lah. Cheating means you go and take management and pura-pura that it is auditor punya. That one tak betul lah. Cannot. We are professional auditor, so we must calculate ourselves. There will always be a difference. This is where the audit standards tells us that difference is not necessarily a misstatement. Right? Not necessarily a misstatement. Now, this is a bit confusing. All right? A bit confusing because people say, if there is a perbezaan, if there is a difference, shouldn't that be a misstatement? So this is where we need to clarify concept again. In auditing world, error and misstatement tak sama. Not the same thing. Spelling different, meaning also different. You see, misstatement got more alphabets. Error got only 5 alphabets. So error means that it is a mistake. It is not intentional. So error is always unintentional. Misstatement in our world in auditing means it is intentional. So one is secara sengaja, the other one is tak sengaja. All right. So when we say that it is not a misstatement, it means that we don't necessarily say that it is intentional. Maybe it is tak sengaja, maybe, but bukan sengaja. All right, and this is very important. Why very important? Because if something is a misstatement, then it will become the dirty F word, fraud. Fraud takes us into another standard, ISA 240, which is also going to change, right? There is an exposure draft right now being tabled, which will amend or overhaul, actually, ISA 240 in the next 18 months. So anyway, the point over here, we are auditor. Auditors are very takut of fraud because when we see fraud, we pengsan straight away. We know already that there's a big boo-boo over there already. So ISA 540 tells us, if there is a difference, please don't think fraud. Please think carefully. Maybe it is something which is unintentional. Right, first principle. Second principle, if the client changes their estimate, remember just now we talked about not consistent, client suka hati lah, just change sahaja the estimate. Dulu straight line, sekarang reducing balance method. Dulu fair value is using market approach, sekarang use cost approach. Then this is where the standard tells us the auditor may conclude that it is misstated because it cannot be unintentional. Right? If a client changes an estimate, that means it is sukarela. Dia tahu, dia buat secara sengaja. Then this is where we will say big problem. All right? They maybe, they are trying to manipulate the financial statement. Manipulate financial statement is important because remember it goes back to the dirty F word called fraud. So fraud, remember in ISA 240 is divided into two principles. One would be misappropriation of assets. Misappropriation of assets means curi assets, misappropriate. Second one is what we call financial reporting manipulation. That means mind with the account, play around with the account. So misstatement here refers to the second part over here. They don't curi the accounts, they mind around with the accounts, okay? So then that means we will need to apply another standard on ISA 450. So notice 450, 540, number not the same also. 540 is estimate, 450 is misstatements, evaluation of the misstatements. And then lastly, we will need to assess the reasonableness of the estimates in the notes to the financial statement. So this is where auditing standards remind us, engkau janganlah pandai-pandai tengok only the balance sheet and the P&L, You must also look at the notes to the accounts after you have done all the earlier procedure. So you see the problem again, It looks as if notes to the accounts dianak tirikan. All right, it has become a stepson, whatever you call it, adopted son, not important. Balance sheet P&L very important, notes to the account not important. That seems to be the flow from the old ISA 540. And that's what we mean by evaluating the reasonableness of your estimate, so to speak. Okay. Now, in the process of doing this evaluation, you therefore will encounter something called bias. Right, management bias. Okay, here's my pen. Wrong ink. Sorry, let me change the ink. Blue, nice, sexy. All right, possible management bias. So why we say management bias is because they're the preparer, the client prepares the accounts, right? So when the client prepares the accounts, obviously we are all human. No matter what kind of AI you use, what kind of software, what kind of ChatGPT you use, ChatGPT and the software is not biased one, it's bodoh one. All right, you put 1 + 1, it'll give you 2. All right, so we accounting human element is where we introduce bias. And this kind of bias is where we as auditor must be very sensitive. Sensitive to what? Sensitive to the audit risk. That's because the audit risk here, there are two kinds of risks. your overstatement, and your understatement. So audit tak susah one. Audit life very easy. Don't know why we have to work until so late. So overstatement here means people like to overstate assets. People like to understate liabilities. Right? People like to overstate revenue. People like to understate expenses. Right? This is general principle only. So here we are therefore saying that, oh, you know, if you are auditing the client makes an estimate. Katakan, again, they are doing ECL, expected credit loss impairment calculation, right? So what would the client be intending to do? They will want to reduce the ECL. Why reduce ECL? Reduce ECL means you can overstate your trade receivable. You can understate your impairment expense in P&L. So this is where ISA 540 back then says that go and identify, are there any indicators of this kind of possible management bias? All right, and how do we identify? Well, we need to look at first the degree of subjectivity involved, because higher degree, higher potential for bias. All right, so higher degree of subjectivity, higher degree of bias. Secondly, we need to also assess whether, again, is it something that could constitute a misstatement or not? And the principle we mentioned just now, it does not on their own constitute misstatement. In other words, bias tidak bersamaan with misstatement. Why? Because we all human, so all human are biased doesn't mean all human are fraudulent. Not necessarily the case. So this is a bit of the older standard what we used to do and why it's a little bit problematic if you start to think for the last 30 minutes, because you can really start to sense that the flow of ISA 540 didn't make sense. The requirements of ISA 540 is not sufficiently robust. Okay, so take, for example, the current slides on management bias, right? I can already tell you two big problems over there. Problem number one, just because the management is biased doesn't mean auditor is not biased, right? Because management has an aggressive biasness, auditor has a conservative biasness. So why is it the standard doesn't recognize auditors' bias? Why does it just recognize clients sahaja yang bias? That's really one problem, right? What's the second problem? Second problem from here is very simple as well. We are audited, right? We are accountants. We are trained in university to do debit and credit. And suddenly, when your students graduate, they are supposed to become psychology graduate as well. They must be able to tell psychologically whether the client is biased or not. This is a bit of a problem, right? Because this is not our traditional training. Our traditional training is debit, credit, do audit, do tax, do valuation. Nobody in college and university taught us how to go and see whether the client is biased or not. That's a problem. That's something that we have always been looking at the auditing standard and say, hey, something not very right. So, what is the Panadol solution? So the Panadol solution is very easy. Ubah the standard, change the standard, right? So when we change the standard or revise the standard, it's very simple. What was last time 20 pages, we just make it 100 pages lah. All right, so what do? We don't change font size. Jangan tukar font size. We just tambah more paragraph. Just taruhlah more paragraphs into the auditing standard to make sure we clarify and guide the auditors as much as possible. So a lot of the things that I shared with you for the last 30 to 40 minutes, don't throw away. It's still there. It's still there, but now what do? We supercharge it. We turbocharge it. We introduce additional requirements, additional guidance, and we realign the process, the thinking process. So what you see therefore on this slide is a high-level summary of the key concepts from the new ISA 540. Number one, we actually now require separation of the IR and CR component. All right, and I'll come to it later, don't worry. Yeah. So what is IR, what's CR, I'll come to it later. So just understand for the moment, because of the new standard, we added 5 times more pages. We will have to separate IR and CR. Number 2, because of the problem called auditor's judgment or professional judgment, we now include in the auditing standard something called a spectrum of inherent risk. So it become a bit rainbow color now, and you'll see that later as well. Number 3, because we have so much judgment and the partner and the audit junior don't see eye to eye, because partner go back 5:30 a.m., junior go back 5:30 p.m., we then have to introduce the concept of inherent risk factors. Then because we have enhanced so many risk factors over there, we also now have to enhance our risk assessment procedure, because we are still risk-based auditor. And then number 5, we introduce an objective-based work requirement, which means it's no longer based just so much on tepuk dada tanya selera. Not enough. We now have principal objectives to guide the auditor to say, hey, you want to go back 5:30, right? Make sure you finish and meet this objective. All right. And lastly, in order to address biasness, we introduce additional paragraphs on the concept of professional skepticism, right? And it's the professional skepticism that I'm going to kickstart with now, all right? Because we just talked about skepticism just now on biasness. So let's talk about professional skepticism. This is the in thing, the key word that we in accounting profession or the auditing, audit profession will be emphasizing, has been emphasizing for the last 2 years, and will be emphasizing and enhancing in the next 5 years. All right, why? We find that technology, using ChatGPT, using generative AI, actually takes away auditors' skepticism. Right? For example, katakan I am auditing impairment of goodwill. All right, impairment of goodwill. So how do we audit impairment of goodwill? We will always ask the client to give me your DCF, discounted cash flows. So when the client gives me the discounted cash flow, it's normally in a Changi Excel spreadsheet, complex Excel spreadsheet. So when you look at a complex Excel spreadsheet, what's the first thing that goes through the auditor's mind? All right, just think about it. The auditor, when they see the complex spreadsheet, the first thing they go blank. They do not know where to start. They do not know where to end. They do not know what's the key issues. They do not know what's the key drivers of the worksheet. Why? Because lecturer didn't teach me once upon a time. Very good. So blame everybody. Blame lecturer, blame the trainer, blame BDO, blame everybody. Nobody teach me. So they go blank. But then when they come and do the audit work, they will then say, because it is in an Excel spreadsheet, Excel is always accurate, therefore must be correct. So when you come to that conclusion, is using Excel, Excel is always accurate, therefore impairment of goodwill is accurate, then lost your professional skepticism already. So this is why ISA 540 was revised. It was revised to now have more emphasis on this concept called professional skepticism. And you notice that it's not just affecting your auditing standards. It's also being incorporated in your code of ethics. So that means if an auditor just say, I terima bulat-bulat, accept wholeheartedly the Excel worksheet without doing anything else, it's a breach of ethics, not an ethical auditor. So you notice, got a lot of requirements coming in already. Okay, so how do we emphasize skepticism moving forward? Remember, ISA 540 was the test-based standard. It was the first of a series of standards that the standard setter used in order to test water, see whether auditors can apply it in practice or not. So in this context and background, therefore, what happened is that first in A, you would see over there, the new standard says that we shall design and perform further audit procedures in a manner that is not biased. For example, we are no longer looking for corroborative evidence. I know in auditing teaching, we always say, oh, audit evidence must be corroborative, must support one another. This is not how it works. In the new auditing standards, we are looking for contradictory evidence. For example, the client uses interest rate that is declining. Discounted cash flow, so discounted cash flow, you need to get discount rate, right? So to get discount rate, they go and use, the management uses a declining interest rate. Because why? They think that the central banks will cut down interest rate. This is where we as an auditor will come in and say, tidak setuju. Do not agree. Why do not agree? Because we have got somebody who is causing havoc in the world trade system that is resulting in potentially inflation. So when there is inflationary pressure, why would interest rates be going down? Wouldn't central banks' role of combating inflation mean they would want to increase interest rate? So you see, under professional skepticism, I as an auditor will no longer be looking for corroborative evidence. I will also be looking for contradictory evidence. So that's A. Because I'm doing this, getting contradictory evidence, that means under B, I will need to use stronger language. That means I will go and challenge the client. Ini bukan boxing, this is not WWE. So we are actually going to challenge the client to say, hey, I hear you, I understand that you are actually using lower interest rate, but may I understand why? Because if you notice, inflationary pressure is on the rise. Why would you then use lower interest rate? Right? So stronger language like challenge and question the client now comes into the auditing standard. So if I don't challenge the client, I am not an auditor, no good auditor. All right, the audit standard says I must challenge the client. Remember, challenge means challenge politely, not go and maki hamun the client and not go for boxing match. No. So once I've done the challenging, obviously what will client do? Client will try to justify, right? They will tell you cerita la Malaysia. So they'll tell you all kinds of grandmother, grandfather story. Then in procedure C, what we do is we take a stand back. Stand back procedure. That's the new thing. So this is new. All right, stand back procedure. So what's stand back? Stand back means take one step back, breathe in, breathe out, take deep breath out, drink a lot of coffee and water. And then after that, start asking yourself a simple question. Does it make sense? Because if it doesn't make sense, that means the client did not convince you, the client conned you. All right, so you need to be very careful. Convincing versus con, the meaning very different as well. So you are asking yourself a question as an auditor, did the client con me or convince me? Now, if the client con me or convince me, we are auditor, we want to go back 5:30 p.m., right? So we tend to think, again, auditor bias. We tend to think, the client's very convincing. So this is where we might need to get second opinion. So that is why in auditing, we have something called EQR. Engagement Quality Reviewer, a second review partner who's independent from the audit team to re-look at our conclusion to say whether is it reasonable or is it not reasonable. Okay, so far, Now, then we will have to, after done stand back, we got the clearance, okay, the client's convincing. It's not end of story. We are then supposed to focus on the client's bias. Focus on the client's bias and understand what is the work effort we need to fight that bias. Because remember, we already counting the auditor bias. How do we counting auditor bias? That's second opinion. All right, so now we need to counting the client's bias. So how do we counting the client's bias? Well, in the first place, that means we must be able to identify in what situations are they exhibiting bias. Right? What is the keadaan that shows that there is a bias? And that keadaan is your indicator. All right, so your indicator of possible management bias is also now in the auditing standard. So the auditing standard says, if the client makes a subjective assessment that there is a change in method to make the estimate, all right, then we have a management bias. So for example, a client suddenly comes to me, I'm the auditor, they tell me as an auditor, oh, Khoon Yeow, I'm going to change my depreciation method. And so we ask this auditor, why? All right, and then the client tells us, because the US president changed. Then we're going to look at the client and say, hey, hello, whether you change US president or not, got nothing to do with your depreciation method, right? So this is possible management bias already. What are we worried about? We are always worried about spurious correlation. All right, spurious correlation. So I think you're all lecturers. I think you're more familiar with this statistical term than me. So this is a term that we find in QM, quantitative methods, whereby we are always worried about spurious correlation. So same thing in auditing. We are worried that the client gives us a convincing story that cons us because it actually is just a spurious correlation, right? Now, second potential bias we're looking for. The client go and develop assumptions or data that gives them favorable estimate. And that is not new. If you remember from 30 minutes ago, I was talking about the same thing already. Right, where the client go and find some cerita, some data, go and find some assumption that then gives them a good fair value or a lower impairment, or better still, don't impair. All right, and we see that a lot. We see that a lot. When? We saw that during COVID-19. We saw that a lot during the COVID-19 period of 2020. Why? Why? Very easy. During COVID-19, if you notice, a lot of companies said business no good, economy no good, everything no good, but impairment not recognized. All right, why impairment not recognized? Oh, because don't worry. My assumption is that post-COVID, we will recover. We will recover better than pre-COVID. Don't know betul ke tak betul one. All right, this is the kind of assumption we are very worried about. And so one of the jokes I used to make is that if people don't impair during COVID-19, then they will never need to impair anything already in the future. Because COVID-19 was such a challenging period, right? It's a pandemic, once in your lifetime. And yet people don't impair assets. People don't impair goodwill. So during the good times, you wouldn't impair, right? Because good times, there's nothing to impair. Good times, positive times. If in the worst time, there's no impairment, in the good times, lagi no need to impair. So this is one of the problems of management bias. The third point, or third bias point, is when the client chooses a point estimate that shows either aggressiveness or conservativeness. Now, this is where you notice there's a change in the standard again. Optimism was in the old standard. Pessimism is introduced into the new standard. Why? Why is very easy. When a client is pessimistic, we as auditor lagi takut. Just to share with you, client aggressive is normal. Normal expectation. But when a client comes to an auditor and say, oh, I want to impair this debtor, I want to impair this asset, even though there's no indicator, never mind lah, I impair, conservative. We are very worried. Because when you actually impair as a client your assets willingly, that's an indicator of fraud. Okay, so katakan, for example, they impair the debtor. So when you impair the debtor already, what happens? Katakan your debtor 100 ringgit, you impair 80 ringgit. Tinggal 20 ringgit sahaja in the balance sheet. But actually what happened in the ground, on the ground, is that maybe the client did collect 100 ringgit. Maybe they collected 100 ringgit, they bagilah 20 ringgit back to the company. Because the debtor balance now 20 ringgit only, 80 ringgit masuk pocket. That's what we are worried about. Right? Or another situation, they impair the motor vehicle. They tell the auditor, this motor vehicle sudah lama so kita impair kau lah, impair to 1 ringgit. So you impair, you're the auditor. You think, this client so good lah. They actually agree to impairment before I even challenge them. So they impair the motor vehicle. And then maybe in years down the road, the motor vehicle also disappear from the fixed asset register. While how the motor vehicle is sitting in the garage or the parking lot of one of the owners or director. become private property instead. That becomes a problem for auditor. This is why the audit standard said, hey, when you look at bias, don't just look at optimism. Don't just look at aggressiveness. Look for conservatism as well, because a conservative estimate can be an indicator of fraud. Okay? All right. Now, next key change. So if you remember from the earlier diagram, the next key change was in relation to the concept of IRS, inherent risk factor. IRS was introduced because, remember, we had problem with judgment, professional judgment. The audit junior will always challenge the audit partner, ask why? Why you say that it is whatever, the high risk or low risk? Audit junior will say, I think it's low risk. Partner will say it's high risk. Why? So the why now goes back into this concept called factors. So first thing first, there are 5 factors that affects our risk assessment, whether it's high risk or low risk. Right? It's very easy to understand. I always call this CSI. So C stands for complexity, S stands for subjectivity, I stands for inherent uncertainty. All right, CSI, inherent uncertainty. And then don't forget, because of ISA 240, fraud. All right, fraud. And do not forget the triangle changes. So in mathematics, your triangle is a change, plain and simple. So CSI 240 change. Now, what is inherent uncertainty? Is easy, right? Inherent uncertainty means that in the first place, the accounting standard don't even tell you how to calculate the value. So if the accounting standard don't even tell you how to calculate the value, it's inherently uncertain already. Okay. Second factor, complex. Complexity is also one whereby they tell you to get that number in the balance sheet, I use a canggih method nobody understands called flow rate method. Katakan, they tell you, I use something called flow rate method. Then pingsan lah. Because then you're wondering, what's that? Flow rate method. Flow rate method, for those of you who do not know, is used to calculate ECL, expected credit loss, under IFRS 9. So complexity of the method, right? Third, subjectivity. So subjectivity means that it is subjective data. All right, it's always about the data. Remember, process is not really subjective. It's more of the data that gives rise to the subjectivity. All right, so for example, I want to calculate the fair value of my shares. My shares is not on the Bursa Malaysia, unquoted. Very common issue in audit. Client has got investment. The investment is not quoted. Client wants to fair value it. Therefore, what's the data that you use? So the data is where you can use things like PE ratio, price to cash flow, price to sales ratio, price to book value ratio. Notice all these are data. Cash flow, sales, book value, these are all data points which can be very subjective. Okay. Now, ISA 240, the fourth factor is ISA 240. That's not new. That's a standard that's completely outside 540. So 240 deals with fraud risk factor. All right, fraud risk factor is not difficult. It's only 5 to 6 pages long in ISA 240. Yeah. Then the last factor is changes. Changes here means that if there's a change in accounting standard, for example. So if there's a change in accounting standard, then that can be an inherent risk factor. So there are 5 factors in ISA 540 now, which is systematically explained in the standard. Okay, and then that will lead us to the spectrum, the rainbow color, as I call it. So in the spectrum of your inherent risk, we have the same 5 factors on the left, your C, S, I, 240 triangle. Right, the 5 factors are there. But you now notice that there is something called a spectrum. So in the spectrum over here, ISA 540 now gives us specific guidance. So for example, it says, if there is a limitation in the knowledge or data, that means higher inherent uncertainty. If the data is readily available, lower estimation uncertainty. When it comes to complexity, if there is a lot of non-linear relationship, multiple data, multiple assumption, then it is a complex estimate. If it is very few assumptions, single set of data only, then obviously not complex, right? If something requires a lot of knowledge and data deficiency, then that means very subjective. If something can be gotten from the market, therefore lower subjectivity. Then when you talk about ISA 240, ISA 240 is easy. You just need to know your fraud triangle. Not love triangle, fraud triangle. So in your fraud triangle, if you recall ISA 240, we say fraud can only happen when there is a triangle factor being met. The triangle factor is your incentive, opportunity, and your motivation. All right, incentive, opportunity, motivation. So if there is high incentive, opportunity, and motivation, you will get high risk factor. If one of the factors is low, then you have low risk factor. And lastly would be changes. So changes, what are we worried about? Nowadays, we are worried in auditing about environmental factor, ESG. ESG plays a role because when it's not a change just in your standard, it's a change in the environment. And it has an impact because it has an impact on valuation. So katakan your client has got a property, the property is located somewhere in Malaysia, and suddenly you realize that when you put on your environmental factor, maybe that place is now more prone to flooding, banjir. Then we have a problem because why? That means the property value will drop. Right? That's what we're looking for as an auditor. So nowadays, we must also incorporate ESG factor into our auditing standards. Right? So that means once you have understood the 5 factors, 5 IRFs, you already are exposed to something called the spectrum of IRFs. Then comes your audit model. So in your audit model, it's very easy. I think you, as all lecturers, you already would have been very familiar with the audit risk model. So audit risk, or as we call it AR, AR is a function of IR, darab CR, darab DR. IR is inherent risk, CR is control risk, DR is detection risk. Very easily, inherent risk is the risk inherent in your financial statement. It can go wrong without even you doing anything. Control risk is the risk that's attributable to weakness in internal control. No control, higher risk, got control, lower risk. Detection risk is the risk of the auditor tido on the job. All right, that's detection risk. The audit procedure not robust enough to detect an error. So in the old days, we used to combine these two and call this RMM. Risk of material misstatement. Why? Why? Because RMM is a canggih word, marketing word, to refer to something that the auditor don't control. So why DR is under our control? Detection risk, if you don't want to sleep on the job, drink more coffee, do more work. All right, but RMM is a factor of the client. For example, client don't want to implement internal control. What can I do? I cannot do anything. The client is in the business of technology, blockchain technology. I cannot tell the client, hey, blockchain very high risk. Now can you please become binding company, printing company? Cannot. All right, so IR and CR is risk that we don't control. So of course, we don't call it in our terms, uncontrollable risk. Cannot, because that means client cannot be controlled. So we use a nice term called RMM, risk of material misstatement. All right, so what happened then is in the good old days, we combine the two risks together, which means if your IR is high, but your control risk is low, what will happen is that your RMM tends to be low. If your IR is high, your control risk is high, then your RMM is high. And obviously, if your IR is low, your control risk is low, your RMM is low, right? And if your IR is low, your control risk is high, then chances are your RMM is somewhere in the middle lah. Don't know whether it's high or low. All right, so this is why in the good old days, we have got a risk factor of RMM called HML, high, moderate, and low. So if you remember this concept, now you're exposed to this concept, then what we're going to do is erase all of it. Why? Why? Because in the new days, we now say that, hey, no. The way we do things now is AR equals to IR equals times CR times GR. Tolong jangan campur aduk. Don't mix it. Separately assess the IR and the CR. Because why? We want to make sure that we can robustly respond to your controls. We do not under audit by falsely relying on internal controls to mitigate inherent risks. So we don't want to campur aduk them anymore, separately assess it. So when we talk about the IRF just now, right? The IRF is purely and exclusively linked to the inherent risk. All right, so therefore, if you look at this whole model again, I know I don't have enough space. Let me just change my ink back to the bottom. AR equals to IR times CR times DR. You will then notice that this IR is driven by your IRF. Your IRF is actually covered by 5 factors. What are the factors again? CSI 240 triangle. All right, and this is now subjected to something called your spectrum. All right, and your spectrum can range from high to low. That's what we do now as an auditor, which means tak mau tengok internal control. Why? Because internal control, remember I told you nasi lemak seller, right? Nasi lemak seller got no internal control. So there's no internal control. Why would you go and look at the control risk? Tengok lah the inherent risk factor sahaja, right? That's what we mean under the separate assessment of your IR and your CR. So what is the result? The result here is when you separate it, the AR tends to be higher. Your overall risk tends to be higher. And when your overall risk tends to be higher, what do? You will sleep lesser. Because the only factor we control in audit is detection risk. We do not control the audit risk. We fix the audit risk. All right? What do you mean by that? So again, we are auditors. In audit, we have to do sampling. Samples is a function of the same formula, just you songsangkan. All right, so if you songsangkan, remember the only thing that we control is detection risk. This is your dependent factor. The right-hand side is your independent factor. So if you look at audit firms don't like audit risk. We tend to fix the audit risk at 5%. 5%. All right, that means if I sign 100 audit reports, we accept that 5 out of 100 mungkin salah, may be wrong. I didn't say salah, I said mungkin salah. All right, so we fix it at 5%. All right, but then the factors that we don't control is IR and CR. So what happens is that if your IR is high, katakan IR is 100%, and your control risk is also 100%, then mampuslah, we will audit kau-kau, because this will become 5% detection risk. 5% detection risk means if you look at your population is 100%. That means 5% di sini tak payah audit, mampuslah auditing 95%. 95% work to do. Okay, very easy to understand, right? So now assuming that your IR, we do a good job to understand the client, and we realize that the IR now is only 50% dan control is still 100%. So if you look at this, therefore, you will notice that magic begins to happen. All right, what kind of magic are we looking at? We are looking at, therefore, 5% divided by 50%. That will now mean that this is equivalent to 10%. So 10% here means on the same diagram, sekarang this now becomes 10%. That means the auditor only need to do 90% work. You notice, so can go home now 5:30. Very simple. Okay, now assuming, let me clear everything first. Assuming, where's my pen? Assuming that same model, DR equals to AR over IR times CR. And your AR, remember, we fix it at 5% already. Katakan that my IR is 50% and my CR is also 50%. What happens? So you will notice, therefore, that you will actually get 0.05 divided by 0.25 to give you detection risk 20%. 20% celebrate, because on the scale of the 0 to 100%, that means I have comfort at 20% already, so therefore I only need to do 80% of work. That affects sample sizes, by the way. So that's why in audit you always wonder, why some people can pick lesser sample, some people pick more sample. It's all a function of, remember, the audit risk model. And so what we have only done in ISA 540 revised is to introduce the splitting of the model. All right, so by splitting the model, remember again, for those of you who are wondering what is Khoon Yeow talking about, we learned the 5 factors of the IRF. The 5 factors, remember, is your CSI 240 fraud and triangle changes. All right, and therefore we are saying we now recognize that there is something called a spectrum. All right, higher to lower. How high is high? The highest is 100% lah. The lowest is 0%. Cannot be negative. All right, and so when you do this, therefore, you will realize that as an auditor, you'll be more targeted. You will know how to make more efficient use of your time in order to focus on the higher risk area. That's what it means over there. Okay, so I hope that explains the concept that we are now seeing under the separation of IR and CR. So because we have now become more granular and more specific, the auditing standard ISA 540 then says, in order to do our testing, remember, test of control is optional. Test of control is optional. So if you're wondering again about the diagram just now, let me just put it again. This is our life. IR, CR, DR. And if you remember, IR is always linked to your IRF. Your IRF, remember, has got your CSI 240 triangle. And if you remember, it's always underlined by a spectrum. Okay, so now we are saying that detect control risk can only dikautimkan or tackled by one thing. That one thing is called test of controls. But remember, test of controls is always optional. Sukarela. Tak boleh paksa rela, because nasi lemak seller might not have control to test. Therefore, we can only deal with detection risk by doing something called substantive procedure. All right, substantive procedure or substantive testing. So I'll just call this SP. Substantive procedure. Now, substantive procedure can be therefore addressed through method ABC. So what's method ABC now? A, B, C. Okay. All right, ABC. Okay, so what is A? A means you use subsequent event. This is where you say, Khoon Yeow, I heard about this 1 hour ago. Betul. 1 hour ago, we talked about subsequent event. You used evidence from balance sheet date up to the date of your auditor's report to attack the risk. That's A. B means you will go and do re-performance. Have you heard of re-performance? Yes. 1 hour ago, if you didn't fall asleep. So 1 hour ago, if you were not asleep, remember I said, right? Test how the client calculated the estimate. All right? Then method C is Sherlock Holmes. Sherlock Holmes means, remember, DIY. Do it yourself as auditor. Develop your auditor's point estimate or range of estimate. So therefore, as an auditor, right, you have A, B, or C to choose from. Now, the beauty of audit, therefore, is it becomes a bit of a science and art for you as well. You can choose all three, A plus B plus C. If you do that, then don't sleep. All right, tak boleh tidur already. Banyak procedure. Okay? Or sometimes some people might say do A sahaja, ataupun B sahaja, ataupun C sahaja. Also can. No problem. A or B or C. Some people will tell you, I want to do rojak. A plus B, or A plus C, or B plus C. So that means you now have what we call options on the table. So option on the table can be A, B, C. A only, B only, C only, A plus B, A plus C, B plus C. Now audit become more exciting. Suddenly no more multiple choice question already. In exam last time, multiple choice question A, B, C, D saja. Sekarang ada banyak combination. So the combination is therefore a function of your risk assessment procedure. All right. So obviously, risk assessment procedure here means the more complex something is, the more you want to do all of them. The less complex, the lesser you need to do all of them. So how do you know which option to pick? Means you need to think. To think means no need to use ChatGPT. ChatGPT cannot think for you. All right, we auditor will have to assess professionally. So that is why we always say, technology cannot replace the auditor. Technology can only support the auditor. Okay, so what is A again? So A is, remember, subsequent event. When do we use it? The standard will tell you. For example, inventory. Stocks just now. Remember, lower of cost and NRV. Another example could be a lawsuit. Katakan the client got sued. So the client got sued, that's before balance sheet date. Maybe the court decided after the balance sheet date. Then we will use method A. All right. Or another one could be debtors. Tak pasti whether you will collect the debtors or not. So maybe after the balance sheet date, the debtors betul-betul bayar balik, pay back. Then you will use subsequent event. All right. So remember, approach A is only applicable, right, when you are able to discern the uncertainty, and the uncertainty is a function of time. So uncertainty is a function of time. Then you will use method A. All right, go for subsequent event. Okay, plain and simple to understand. Now, when would you use method B then? The standard will then say method B is when it is not a function of time anymore, but the client has got a canggih method of calculating the estimate. So when they have a canggih method, then we will introduce you to the terminology called MAD. MAD, not gila. MAD. This one. Right? Method, assumption, data. So it's very simple, right? The client has got an estimate. The estimate is complex. Tauge writing. So it's complex. Therefore, we will need to audit the M, A, and the D. So when we audit the M, A, and the D, we are looking for first, is the method appropriate or not? Does the method indicate bias or not? Method can indicate bias, by the way. So say, for example, in the valuation of unquoted shares, the client wants to use PE ratio. All right, but then the industry uses price to cash flow method. Then you already know that the use of PE might be biased. Why? Maybe because the client got super profit during the year. So super profit means it will drive the valuation up. So that's bias really method. All right, assumption. Assumption is important for auditors. Why? Because one thing we recognize in statistical methods, all models are wrong. All models are wrong because they are limited by their assumption. So knowing the assumptions is critical for an auditor because we will need to check whether the assumption is appropriate or not. All right, so say, for example, very commonly used in auditing, when we do look at audit, normally clients need to estimate discount rate. All right, discount rate is used to discount your cash flows. So in doing the discount rate R is normally used as a function of your weighted average cost of capital. Your weighted average cost of capital is a function of cost of debt and cost of equity. And a very common thing clients use to measure cost of equity is the capital asset pricing model, the CAPM. So the CAPM, for those of you who are unfamiliar, will be your RF plus your RM minus RF multiplied by your beta. Fantastic. And how do we estimate the beta? The beta is a function of covariance divided by variance. All right, these are all statistical methods, by the way. So what's the problem with this method? The method looks beautiful, it looks sexy, can be calculated. However, it is based on an assumption. What is the assumption? The assumption here is that your client is fully diversified. Fully diversified, because that's what William Sharpe said, right? When William Sharpe wrote the capital asset pricing model, he said that your unsystematic risk has been fully diversified away, leaving only systematic risk. But the client is not fully diversified. The client could be in property development. If the client is in property development, he has no exposure to technology. What makes you think that it's fully diversified? So this is where the assumptions might not be appropriate. And when it's not appropriate, what do? We do adjusted capital. We adjust the model to reflect the lack of diversification. Right? So what do we adjust? We adjust the beta factor basically. Okay, that's assumptions. Now, data is data. Data means that it must come from reliable source. So we are auditors. We always like third-party sources. Third party. All right, because independent, all right, independent, always reliable. But that's not enough. As you know, right now, we have got a growing area called data science. With the growth of data science, what's the problem with data? The problem with data is always noise. Not BSing, noise, data noise. So in data noise, we're always looking at the stream of data and we are saying, hey, which one of these are outliers? Which one of these is appropriate? Which period of data is appropriate? And I say period because why? We are faced with a very interesting situation today, again, due to COVID-19. Right? COVID-19 means the period of 2020 to 2022. So if the client uses data from 2020 to 2022, koyak. Sure, koyak one, because the data is all gibberish, it has a lot of noise in it. If you use 2023 to 2024, maybe, but this is already called post-COVID. And the post-COVID data from 2023 to 2024 reflects a lot of new uncertainty. Misalnya, Ukrainian war. All right, the Ukrainian war resulted in a lot of new data noise in the years 2023 to 2024. So have we understood this data? Have we standardized the data? Have we done our t-test and z-test to statistically understand the reliability of the data point? That's what we are looking for under approach B. Okay, Now, approach C means I tak kisah about the client. I want to redo this as an auditor. So when I do this as an auditor, that means I can use different model from the client. Or I can use the client's model tapi guna sendiri punya data and assumption. Right? Or I could use video boleh method, auditor's own method. All right, which means I don't use management model, don't want to use whatever model, use our own proprietary model in BDO. All right, or I might go and hire an expert who re-looks at the calculations. Or I might go and do my Sherlock Holmes research to find other companies in the market to see what other competitors are doing in the market. That's approach C. So C can be very exciting for a lot of young auditor because you know like young auditor, they like to do something different from the market. So once we understand, now in the revised ISA 540, we've got A, B, and C, then don't forget that we are supposed to demonstrate skepticism by taking one step back, the stand back approach. So in the stand back approach, remember, we are not just looking for corroborative, we are looking for contradictory. Contradictory is the in thing for auditors today. All right, so we will be skeptical. We will always be testing for contradictory evidence, and then don't forget to document this in the working paper. All right, so when we talk about documentation, ISA 540 even tells us this is the dirty laundry list of things we must document in the working paper. We must document our understanding of the client, understanding of the environment, understanding of the client's internal controls, show the linkage between the RMM and our risk assessment procedure. Show them our response. What happens if the client didn't take steps to address uncertainty? Document down what is the possible management bias that we observe and document down our judgment basically. Right? So once we've documented down, then don't forget, ISA 540 says, please also have a letter of representation to deal with the MAD, method, assumptions, and the data. All right? And then once we have gotten all this on a piece of paper, now they don't use paper, we use technology, notebooks, we put in the spreadsheet and Word files, then don't forget to tell the client, communicate. So this is new, by the way. New. So that means in the past, people don't understand auditor. They don't know why auditor work until 5:30 in the morning. So moving forward, we will educate the client, communicate to them, tell them, because of my risk assessment process, I found out that you got problem in all these areas. Because of all the problem in these areas, I need to work no day, no night. I must communicate to the client. And then because I work no day, no night, please increase my audit fee. That's the whole purpose of communication. Okay? All right. So, any questions at this juncture before I not end the training? This is only end ISA 540. I still have 2 more ISAs to go through with you. Any questions so far? Let me just see the chat box. No question. Other than, okay. Well, would he be sharing the presentation? Yes. I think I'll be emailing the slides over to MIA MICPA later on, and you should be able to email it to the rest of you. Photo session separate matter, Bermuda Triangle. Yes, very interesting as well. So we have got Bermuda Triangle and Fraud Triangle as well. Fantastic. Okay, don't worry. I still have got another 1 hour 45 minutes with you. Don't worry. So, if there are no questions at this juncture, I'm going to move to the next ISA, ISA 315 now. ISA 315. So what's ISA 315? ISA 315 deals with a concept called risk identification and risk assessment. Okay, and for those of you who are wondering what's this risk identification and risk assessment, let me just run through with you very, very easily. So in audit, in audit process flow. Process flow. Audit always starts with scoping. When we scope, we want to have our scope of work. We want to know what we're supposed to do. What are we supposed to audit? What is our materiality level? What is our to-do list, so to speak. Once we know our to-do list, we then have to do risk. So risk is divided into 3 stages. Risk identification, risk assessment, and risk response. Okay, risk identification, risk assessment, and risk response. All right, so risk identification, assessment, and response will mean that identification and assessment falls under ISA 315. That's what we are covering. Risk response falls under 330. Okay, so once we have done risk identification and assessment, we will then execute the audit, perform the procedures before we can conclude. All right, so we are now looking at risk identification and assessment under ISA 315. Okay, so under ISA 315, that means in the good old days, we already have it. We already have it, but it is a little bit different, So what do we used to do before the amended standards? So once upon a time, if you remember just now, the diagram, we have something called scoping. Right, scoping. This stage is scoping. So when we scope, we understand the client, we understand the environment, we understand the internal controls, we do something called preliminary analytical review procedures. We open our big mouth to ask inquiry of the client, and then we do perbincangan. Discuss among the engagement team members. Why? Because we need to communicate to everybody so that we don't have audit junior blah go and ask the client, hey, dear client, what business are you in? The client will pingsan, the audit partner will also pingsan, right? So we scope by doing the understanding, inquiry, discuss. After we discuss, then we will do our risk identification. So risk identification is here. And then we have got our risk assessment. And then we have the risk response. Now, in the risk identification in the old days, we used to identify RMM. Remember, RMM is comprising of what? IR times CR. Dahulu. Even until today, conceptually. IR times CR equals to RMM. And the RMM dibahagikan into 2 levels, assertion level and financial statement level, or sometimes we call it engagement level. Why? Why is because last time our audit risk model not so complex one, right? Audit risk model is still like this, IR, CR, DR. Okay, and the whole idea back then is that we say, combine these two, call it RMM. All right, the RMM is divided into 2. Engagement level, assertion level. Engagement level is also financial statement level, by the way, FS level. Right? And if you notice, therefore, we actually have got in this factor under control risk, remember, internal controls. Right? And the internal controls is also divided into 2. Engagement level controls or entity level controls and assertion level controls. So the idea over here is that this is used to attack this. This, okay, that's my pen. My pen hilang for a minute. Is used to attack this. Activity level controls mengkautimkan and assertion level risk. Entity level control mengkautimkan entity level engagement level risk. That's the old risk model, as we called it in the past. So the idea at that time was to split your RMM into two, and then you assess the risk accordingly. So when you assess the risk, that means in your risk assessment, this will either be high, moderate, or low. This will either be effective or not effective, strong or not strong, plain and simple, right? So if you remember, if you look at the metrics, you can really build your risk response already if you think about it. Why? Why is because if you notice, you can have a situation of EL risk versus ELC, right? So this can be high, moderate, and low. Your ELC is strong or neutral, right? So if it is high risk versus strong control, you will therefore have lower RMM, right? If you have got high risk versus H versus neutral control, then you will have high RMM. Right? Plain and simple. Same thing, same thing. Now when it comes to moderate, so moderate can be interrelated with strong control. So if moderate risk linked with strong control, you will get low RMM. If you have got moderate attacking or dealing with neutral controls, weak controls, that means you will have moderate RMM. If you have got low risk versus strong internal controls, you will have very low RMM. And if obviously you have got a low risk versus neutral controls, you will have low RMM. And then you will respond to the risk accordingly. So this was what we call the risk matrix. So you might have heard of this terminology from some audit firms. I'll tell you risk matrix, not itu movie punya matrix. This is risk matrix. So yes, auditor can be quite fun, can be quite Hollywood movie type also, can have our own matrix, so to speak. And then we respond to the risk accordingly. That's in the old standard, so to speak, before we had the revision. So in the old standard as well, because of the matrix I showed you just now, therefore understanding internal control is important. Because why we say that, oh, you know, you should be doing types of control, seriously speaking. All right. And therefore, it also will mean in the old standard, remember, we split between assertion and financial statement level, and we still only attack significant high risk, not the low risk area. So things were a little bit matrix driven in the old standard. Now, if you pause for a minute and you think about ISA 540, the one that I was sharing for more than 1 hour just now. Remember 540 was the genesis, the beginning of change, right? When the standard setter says, we want to transform the way auditors do audit. We want to transform the way auditors think. Okay, so what happened then is that they said, when we transform it, if you remember just now, we no longer combine IR and CR. We want to split the IR and the CR accordingly. So what will therefore happen in the new revised 315 is to flow through the same thought process. So by flowing through the same thought process, you will notice today that the risk assessment process is now part and parcel of your scoping. Your controls will now be not part of your risk identification anymore. No more. All right, so we will no longer have the RMM combination. Tada already. You will still have, as what you have seen in the earlier lecture this morning, the same risk model. It's just that this IR will now give rise to IRMM. Inherent risk of material misstatement. Right, so you have got two levels therefore of IRMM. Let me just erase this just to make it now easier for me to common flow the diagram for you. IR is now split into two. One would be the entity level risk, which we still call financial statement risk. The other one is your IRMM. Right? So we don't combine IR and CR anymore. Okay, and the idea here is still the same. You understand the environment, you understand the accounting standard, you understand the client, you understand internal control, you do your preliminary analytical review, you do your inquiry of the client, you bincang in the team, and then you will identify potential risks arising from the IRMM and the financial statement level. So that means you don't think about controls anymore. Just because the client has strong internal control does not mean that you don't need to do risk assessment. Okay, so in the older diagram, yes, strong internal control, no need to do IR, no need to do inherent risk assessment anymore. Now cannot. Now must use your thinking hat to ignore the controls already. So when we do that, we will therefore need to split our assessment into the two levels. And from this level, you can already see the interaction with your IRF. IRF is not new, huh? IRF is your inherent risk factor. And if you were paying attention to the earlier part of the lecture, you remember IRF is divided into 5, right? CSI 240 and triangle changes. And you will also remember there's something called the spectrum of inherent risk. So you therefore now see ISA 315 was revised to make it more granular, more specific, so that auditors can tell the client, why am I working late? I'm working late not because you have strong internal controls. I'm working late because I have got risk factors in your financial statement which inherently give rise to high risk. And because your controls may not be effective or your controls may be non-existent, I now need to spend more time to pick more samples and do more work. That's what we mean under the overview over here. Okay? All right, so that means, therefore, with this more granular risk factors and risk assessment, we would therefore need to have a more robust risk assessment process. Now, remember, when we talk about risk assessment process, yeah, everything is always a function of the word called risk. So risk is a function of probability and magnitude. All right, in other words, amount and timing as well. So probability is your likelihood, magnitude is magnitude, right? So probability or likelihood will therefore mean the higher it is probable, the higher the risk will be. So lower probability, lower risk, higher probability, higher risk. Magnitude is a function of impact, not materiality. Remember, magnitude and materiality share the same M, but they're not the same spelling. So different, also the meaning also very different. Right? Magnitude is a function of impact. So if it is wrong, right? If it is wrong, what is the impact? If the impact is high impact, then that means high risk. So this is where auditors are worried about what we call black swan event. So what is a black swan event? A black swan event means low probability and high magnitude. That is your black swan event. All right, and did we see it? Yes, we experienced it in 2020. It's called your COVID 2022, your COVID-19 era. So your COVID-19 era is the one whereby we looked at it and we say, that was a time when the pandemic hit and we all had a major problem, which we never anticipated. All right, so now we will model that moving forward into a spectrum of inherent risk to derive our risk conclusion. So you will then be asking, hey, Khoon Yeow, you're the auditor. So, okay, I understand the theory of risk assessment. How does it work? So how does it work is where, remember, we split the two factors, IR and CR. So in your IR, we will go based on your factors. Your CR, however, is based on your internal control strength, the risk that something could go wrong and it is not prevented or detected by the internal controls. If you think about it carefully, this is actually borrowed from ISA 540. So that is why I mentioned earlier this morning, right? If you understand 540, the genesis of how it was changed and why it was changed, you automatically understand ISA 315, because 315 is an extrapolation of ISA 540. Okay, so this part I don't have to explain further already. I've gone through in very detail when we talk about ISA 540 just now. So how we do it is therefore, as an auditor, we will have to do all these procedures like understanding. So what do we understand? We must understand the client's organizational structure. We must understand the client's ownership and governance. We must understand the client's business model. We must understand the industry. We must understand the KPIs of the client, and we must understand the client's internal controls as well as accounting framework. So if you think about it carefully, right? Audit is not about go and pick invoices to vouch. Audit is not about employing analytics. Audit is about how much do you understand the client in the first place. And this is exactly the problem we have today with audit recruits. That is because audit recruits who come from the universities, who graduate from the universities or even anywhere, it doesn't matter wherever you're from, they all suffer from the same problem of I learned all these audit procedures during my 4 years in university. My lecturer teach me these are the 100 audit procedures to do. But nobody has emphasized on understanding a business. All right, and this is where the ISA 315 says, hey man, as the auditor, don't bother about procedure, because procedures is in the library. The audit library is there. You don't, it's open book exam. You can just open your audit software, audit manual, audit standard, you find all the 100 procedures. The problem here is, do you understand the industry? Do you understand the business? And this is where we have problem, because why? Audit graduates have zero understanding of businesses. Now, when I say zero understanding of businesses, do not misunderstand me. They have zero understanding of the organizational structure and regulatory factors and stuff like that. But when you talk about understanding of a new business model, our graduates are fantastic. All right, so say, for example, the TikTok economy. So the TikTok economy, they got very good understanding. All right, I have got children, daughters who can talk to me about how they can sell products online using TikTok without even me having a clue of what they're talking about. But they understand how it works perfectly well. All right. Likewise, I've got graduates, I talk to graduates who can tell me about blockchain technology, digital ledger technology, and how blockchain can be turned into a transformative business model that can actually automate quite a fair bit of things. So we need to therefore leverage on their strengths and also highlight to them their weakness. That business model is not just that. You also need to understand all the other models in this world, the other factors in this world. So when we combine all of this together, then and only then we are able to put them to assess the probability and the magnitude. And then from there, identify whether is it high risk or low risk based on the spectrum of inherent risk. Okay. Now, in the understanding of the probability and the magnitude, one thing that we like about audit is looking at last year's file. So looking at last year's file gives us the history of errors. So where the client has a history of errors, that means the probability of error happening is higher. All right. And if it is no history of error, that means probability of an error is lower. Right, so looking at last year's file gives us a good understanding as well on the probability. So then that means in practice, what we do is to, once we have identified all those understanding, we then do a mapping, color mapping or heat map, whatever you want to call it, of the 5 factors. So the 5 factors you can see over there, CSI, ISA 240, and the changes. So when you have got these, you will notice you've got a heat map factors that you can see as an example over there. You will notice, therefore, you have got your probability and magnitude given on the X and Y axes accordingly. So you heat map them, and based on the heat map, obviously, as audit partners, we focus on this. Right, that means we will tell the audit junior, please lah, don't waste time doing this. Please lah, don't waste time doing that. Please look at all these risks that I've circled on the heat map and go and design your audit procedures in order to respond to those particular risks. Okay, so in that process, therefore, it means that we will need to have an assessment of the inherent risk. We will need to have a combination of the probability and magnitude. Remember, it's interrelated on the X and the Y axis. And then we will need to be precise in our response. So the precision of response means we respond directly to the risk that we have circled in the diagram just now. And that also means the risk response is not always the same. It will change or it will vary based on the nature, size, and complexity of the client. And it also doesn't mean that it must be high risk, high magnitude, and high probability to get high risk. So if we go back to this diagram again, something that is high does not necessarily mean that it must actually be high all the way. It could even be sitting in the middle over here that can give rise to a high risk that we need to respond accordingly. Okay? All right. So with that, we will then conclude the risk assessment process. But remember, taking one step back, stand back is still there, by the way, to understand the factors that will give rise to our overall response. So for example, do we have fraud risk factor in existence? Is there an economic development that requires specific attention? And speaking of economic development, this is something that we observe a lot in practice. So take, for example, in Malaysia, yes, I said ESG is one factor that has got a lot of impact on us. Take another one, data centers. Take another one, trade war. So trade war important, trade war important because why? It explains to you why Penang is having a lot of development. Data center important, why? It explains to you why Johor is having a lot of development. So these are economic developments that we look at and we say, hey man, because of that, it gives rise to a specific risk in that audit client base in Penang or in that audit client base in Johor, right? Now, other factors include transactions with high complexity, and normally this is arising from mergers and acquisitions. Right, so when clients go about acquiring businesses, there's some form of complexity involved. Significant transactions with related parties is your other ISA, that's your ISA 550, if I'm not mistaken. Judgmental matters, high subjectivity in measurement, high estimation uncertainty, and non-routine transactions. So these are all factors that will lead to a high risk conclusion in our overall risk response, so to speak. And remember, high risk means more work, more time to be spent. Yeah. So that covers inherent risk. What I've just covered with you is inherent risk, IR. What about CR, control risk? So when it comes to control risk, ISA 315 was also amended to become more granular already, right? So how do we make it more granular? Let's go back to the audit risk model. AR equals to IR times CR times DR. I spent the last 30 minutes just looking at IR. Now let's spend a bit of time looking at CR, control risk. So in control risk, it is predominantly divided into 2 levels, right? One would be, if you remember, the overall environment. The other one will be the specific environment, the specific controls. Specific controls is what we call CARA. CARA is not your girlfriend. Huh? CARA is the name of control activities relevant to the audit. All right, you will see it in point number 5 over here. All right, so CARA is control activities relevant to the audit. The overall control risk is then what we look at in terms of the 4 other factors under the revised ISA 315. CE, control environment, ERP, entity risk process, monitoring controls, and IS. All right, so control environment, ERP, monitoring controls, and your IS. So when you look at this, understand one thing. These 3 is not new. This is where emphasis has been added. Information systems. And that is because if you look at information systems has a direct effect on the CARA. Why do we say this is because of COVID-19? Turn back the clock again to the era of COVID-19. COVID-19 has resulted in one thing we never anticipated. For the many years, if you look at the good old days, when you ask the boss to learn about technology and computer, boss will tell you, malas lah, lazy lah, they won't let the youngster to do. Huh? And then when COVID happened, COVID did what the chief technology officer couldn't do. Right? It educated the dinosaur bosses. So suddenly the dinosaur bosses who have no clue how to even turn on the computer became overnight expert in using computer. They suddenly become expert in using Microsoft Teams, in using Zoom, in using all kinds of canggih things. COVID resulted in us no longer going back to office at that time. It's called duduk diam-diam di rumah, right? MCO, movement control order. So because of movement control order, what do? We start to create documents in the cloud. We have invoices, we have got delivery notes, we have got agreements all stored in the cloud. Because of COVID, we no longer need to write checks. Right? Because of COVID, we now do electronic funds transfer. Everything went into an IT environment. And the IT environment has an impact on your CARA because now auditors can no longer say, I don't know how to do IT audit. Auditors now must learn how to do IT audit because the documents are not physical documents. The documents are now electronic documents. So this is where, again, we always tell universities and colleges, right? Your syllabus needs to be improved because IT and IS, information systems, is no longer about just environmental factor. We need to educate our graduates and the new recruits on how they can use digital technologies to audit digital technologies. All right, so in the old days, we used to call it kucings, cats, computer assisted auditing techniques. So that cats or kucing will not become a tiger already, moving forward, become a harimau. Because what happens is hari-hari, you need to use cats in order to audit the client's overall control activity. So if you ask me again, Khoon Yeow, why did ISA 315 change? Understand, it's also because there's a change in environment. COVID did what we didn't expect many years ago. Okay, so because of that, when you come back to therefore the control activities testing, when we say auditor do test of control, always remember we cannot test control environment. We cannot test the risk process. We can only test CARA. All right, so we can only test control activities that are relevant to the audit. Why? Because if a control is not relevant to the audit, who asks you to be busybody? All right, go and test a control that's not relevant to the audit, right? So therefore, as auditors, we only do test of controls over CARA. Now, when we do test of controls over CARA, that means in the first place, we must know what is a CARA, right? And a CARA, therefore, is something that is relevant to your risk. So again, remember, right? We were talking earlier this whole morning about AR equals to IR times CR times DR, right? And we are saying that, first of all, identify your IRF. Because your IRS will tell you which are the CARA under your control risk that you need to test. All right. In other words, if there is a risk factor arising from revenue recognition, I'm not going to do tests of controls over the bank reconciliation. It makes no sense, right? My risk is over revenue recognition. Why would I want to bother testing the controls over bank reconciliation? Take another example. My risk factors arising from impairment of debtors. Why would I want to bother about testing controls over my fixed assets, fixed asset tagging? It doesn't make sense, right? I need to do a control activity testing that is relevant to that risk factor. That's what we mean by CARA. So knowing your CARA therefore means knowing your control risk factors. Your control risk factors must directly relate to your IRF, right? And your control risk factors will have some level of interaction with your CSI. It will also have some factor of reliance with your ISA 240. It will also have some reliance on changes. Why? Why is simple? If there's a change in control, don't test. Right? Why? Because if there's a change in control and you test that control, chances are your control might not be effective yet because it's a new control. Right? Think about it. Now, if there's a fraud risk, why would you test controls? If there is a fraud risk, that means somebody is overriding the controls. So don't test the control. So this is how control risk factors have an inverse relationship with your IRFs. All right, so knowing your CRF will be a direct opposite of your IRF, so to speak. Okay, now having said that, however, if the stars are aligned, all right, if the stars are aligned and your audit partner says, I think we should do tests of control because like banking sector, especially or financial services, must test controls. So therefore, we will then ask these key questions. We want to know whether is the control designed correctly or not. We want to know whether is the control implemented correctly or not. This is what we call D&I. All right, design and implementation of the CARA. So how do we know whether the D&I is appropriate or not? We ask simple 3 questions only. Number 1, does it exist? Because if the control doesn't exist, then there's nothing to test, right? It doesn't exist, cannot test. Secondly, is the control properly designed or not? Because if it is not properly designed, why test something that's not properly designed? Third, do the client even use that control or not? Because to the client, if the control is there, it's properly designed, but the client don't even use the control, then what are you testing? No point, right? No point to test something that's not being used. So that's what I mean by the D&I, design and implementation question. So at this stage, I know you might be a bit lost already. I wonder, this Khoon Yeow apa dia cakap? Sudah lost lah. All right, let's go back to audit risk model again. AR equals to IR times CR times DR. If you were awake earlier this morning, I introduced to you the IRFs. In assessing the IRF, I introduced another word for you called what could go wrong. WCGW, what could go wrong? Because what could go wrong gives rise to the risk, right? If something can go wrong, chances are it will go wrong. All right, without controls, it will go wrong. All right, so what could go wrong is your risk factors already. In a way, it leads to your risk factor. So if you think about it carefully, if I know what could go wrong and I am the client, what would I do? So if I'm a director of a client and I know what could go wrong, what would I do? I will mitigate. I will mitigate. How do I mitigate? I will come up with controls. Right? I'll come up all kinds of controls to mitigate what could go wrong. All right. So when I implement those controls, we call that internal controls. Remember, internal controls is implemented by the client, not by the auditor. Okay. We are auditor. Therefore, as the auditor, I am only interested with CARA. In doing the CARA, I will need to first assess the design and implementation of that internal control. Because if the internal control don't exist, no CARA. If the internal control is not properly effectively designed, no CARA. If the client doesn't even bother to use that internal control that they already have in the manual, no CARA. Right, so you can see the linkage is a cycle actually between the CR to the IR. And that's because in the universe of internal controls, there are controls that are relevant. Obviously, there are also controls which are not relevant. So controls which are not relevant, I don't want to know. We are auditors, we are very focused on the factor. All right, so therefore, if you notice, the CARA is actually driven in a way by your control risk factor. Your control risk factor is interrelated with the inherent risk factor. So if you look at this whole diagram, therefore, now you can see a bigger picture that interrelates IRF, CRF, CARA, D&I, as well as what could go wrong. So you see, therefore, why we have split the whole risk model under your ISA 315 revised. Okay, so I hope that helps to give you better explanation of the risk assessment process itself. Now, if you recall just now, I talked about the thing that requires a bit more attention today. The thing that requires a bit more attention today is information system, or sometimes IT as we call it. And we call that IT information system because if you recall, COVID changed everything, right? So even last time, clients might not be using accounting software. Because of COVID, now everything goes on the accounting software. All right, so we are auditors. We must understand the client's information system. We must understand, hey, where do they keep their records? How does the data flow diagram look like? Where is the financial reporting process maintained? What are the outsourced human resources or outsourced IT resources used to maintain the accounting information? And that is because if you notice, the other trend is people outsource their accounting function. A lot of SMEs outsource their accounting function. So when it is outsourced, that means we have to obtain even more understanding of the database management system, the operating system, the network system. And then only from there, we can design and implement our test of controls in order to effectively assess that particular internal control. In doing this, therefore, ISA 315 says, hold on, you must again differentiate between general controls and application control. That's because, remember, we don't test general controls. We test application controls. TOCs is always over application control, not over the general control. Because general control is IT environment. I cannot go and ask, hey, how good is the Microsoft environment? That doesn't make any sense. I can, however, do a test over the specific Microsoft application that actually derives or yields my accounting information. That's why the standard says, please differentiate between general controls versus application controls. And you might be wondering, contohnya, example. So example could be, for example, at the IT environment level, we are not worried about test of control. We are more worried about things like access, network security, backup control. But if the client doesn't have this control, it doesn't mean that the audit will fail. Right? For example, I've not met anybody who signed an audit report to say, we qualify the audit report because the client don't have backup control. Never seen before. Right? I've never seen an auditor sign audit report to say, we qualify the audit opinion because the client don't have network security. Haven't seen before. Right? Haven't seen before. But when it comes to application control, it's very different. Application control is over the exact software or whatever application that has an impact to the financial statement punya. All right, and that one we can qualify one, because that one is also inside Companies Act 2016. CA 2016 requires a financial statement auditor in Malaysia to make sure that the accounting records is properly kept. So if the client software koyak in the first place, it doesn't even maintain the accounting records properly, we can qualify the audit report. Because it's not just about the auditing standard, it's even in the Companies Act 2016. So you notice, therefore, we must differentiate as auditor application control versus environmental general control, because it really has a different impact on the audit report. Yeah. Now, what is the newer thing that has come into board? The newer thing that comes on board is obviously cyber attacks. So cyber attacks is now a growing area even in audit, because the problem in life is that cyber attacks can transcend environment and application. Somebody who has hacked your password can literally lock you out from your accounting system. And if they lock you out from your accounting system, we have a problem, isn't it? Because that means we are not able to access the integrity of your accounting records anymore. So cyber attack is a growing area, and that is why you notice a lot of recent changes to the ISAs and the ethical standards is arising from technology. All right, because technology is evolving, therefore it will have that impact on the auditor as well. Okay. All right. Now, remember, we have also one last thing to do under ISA 315 that we learned from ISA 540. That's called professional skepticism. So to emphasize professional skepticism, after we think about the IRF, the CRF, and all those risk factors just now, we need to take one step back. That's a stand back provision. So in the stand back provision, what are we worried about? We are worried about things that we omitted, that we miss out. So when we miss out, it can be two things. One is completely lupa. All right, completely omitted. The other one is we thought that it is not significant. Right, so we thought not high risk, everything low risk. So if you take one step back and you say everything is low risk, then something is wrong with the auditor, not something wrong with the client. All right, because it usually means the auditor want to curi tulang, go back 5:30 p.m. Therefore, they went to go and put everything low risk. Or they miss out everything they miss out. That's what we're worried about. So that's what we mean by stand back. Take one step back, ask yourself, have you done the risk assessment appropriately or not? And in doing this, therefore, remember why we have got EQRs again, Engagement Quality Reviewer. Because Engagement Quality Reviewer is an independent partner who will take also one step independently back from you to ask, have you done your job appropriately or not? Okay? Right, so that's the last bit in relation to ISA 315 changes, which is actually an overhaul which extrapolates ISA 540. So, any questions at this junction? Let me just go to the chat box question. All right, so question over here. Let me see. What kind of challenges would an auditor face in distinguishing the IR and the CR? Well, actually, in practice, we don't face a challenge in differentiating IR and CR. The reason why we don't have a problem in differentiating IR and CR is because control risk is always a function of internal controls. So anything to do with internal controls, we already know is linked under control risk already. All right. So everything else therefore becomes inherent risk. The risk of the accounts going wrong even without controls to begin with. So in the other way to explain is that we always interrelate inherent risk with business risk. So if you think of business risk has nothing to do with controls. Budgets is control. Budget, therefore, control risk. So this is not really a very difficult thing for us to differentiate in practice. Yeah. Next question. Okay. How do auditors measure the impact and how accurate it is? Okay. In measurement of impact, very good question. In measurement of impact, that means I'm going back to probability and magnitude. In the measurement of impact, we do not actually need to be exact. We don't need to be exact. Yeah. All we need to do is, first of all, know what is our materiality threshold. Materiality threshold is calculated by auditors even before we start the risk process. There's a separate ISA for this event. And in general, we always take percentage of a base. So for example, it could be 1% of revenue, or it could be 5% of profit before tax. And from there on, we already say, oh, if this thing go wrong, does it affect at least 5% of PBT? If you say yes, it's material already. I don't have to be accurate. I just need to agak-agak. Because remember, I haven't started my audit, so therefore I'm only estimating. All right, so good question about the measurement of impact, but remember, it doesn't have to be accurate. Another question over here. In our opinion, which aspects of business operations should students focus on to develop a stronger understanding of the risk assessment process in auditing? Are there specific areas such as financial management, industry regulations, or strategic decision making that you believe is most critical for people to grasp? You actually have named the exact areas where auditors need or graduates need to develop better understanding. All right, we need to have better understanding exactly that. Financial management concept, industry regulations, as well as business strategy. All three are actually integral to accounting education. And that is because a lot of corporations out there obviously have their own strategy, obviously are bound by the laws and regulations and the norms of the industry. And very interestingly, they're bound by their financial management systems as well. So financial management is where, if you recall, I was talking about things like CAPM, for instance. So CAPM is a financial management concept, right? And if you think about another term I use, WACC, weighted average cost of capital, that's also a financial management concept. All companies want to lower down their WACC, plain and simple, right? So this is where a graduate should first know, hey, what's WACC in the first place? Secondly, how do I lower down the weighted average cost of capital? So how do I lower down? Very easy, right? Remember, we said it's a function of KD and KE, cost of debt, cost of equity. We also know KD is always lower than KE. The cost of equity is always higher than the cost of debt. Therefore, how do you lower your WACC? Very easy. Borrow more. All right. W is your weight of debt versus weight of equity. So if the pie is 100%, 100% represents your cost of capital. Okay. If I were to split this into 50-50, it will not debt versus equity. It will not be the same, right? If I put it 80-20, because 80-20, 80% debt, 20% equity means that my WACC will potentially be lower. All right, so it's easy, right? Cost of debt, let's just say, is 5%. Cost of equity, 8%. 50-50 means you take 50% of 5% plus 50% of 8%. Right? But if it's 80% of 5% plus 20% of 8%, you will notice that your WACC will become lower. So as an auditor, automatically you know already, oh, my client increased gearing during the year. in order to lower down WACC. That makes sense. That means as an auditor, what is my RMM? My RMM now is the going concern. Because why? Higher gearing, higher gearing here means there's a higher chance of business failure. These are the kind of financial management concepts that we need students to grasp, understand, and then be able to apply when they come into the practical auditing world as well. Okay? All right, another question. For IT section, operation auditor do the audit or IT auditor need to verify the system? Well, usually for the IT section, we get the IT auditors. And that is because the IT auditors are trained in a different spectrum of auditing. They actually interrogate systems. All right, so you are now talking about this part, IS and communication. We need IS auditors because the IS auditors are not just going to interrogate the application bit. They're not just going to interrogate the operating system. They also need to tell us things like the database and the personnel, for instance. So the last thing we need, right? The last thing we need as auditor is suddenly you got IT personnel who don't have any qualification in IT. Then we pingsan, right? Because we say, alamak, even the client fellow who's maintaining the database is not even an IT graduate to begin with. So this is why we need IT people to come in, do all the assessments of the IT components, apply even the COSO framework in IT point of view, and then tell us exactly where are the weaknesses in the IT systems. Remember, we want to know the weaknesses, not the strengths. Nobody will complain about strength one. When somebody is strong, no problem. It's when it's weak, that's where the problem is, because weak means it is vulnerable for an attack. What kind of attack? Cyber attack. That's what we are worried about. Okay. All right. Last question over there before I go to the next topic will be in relation to okay. Well, quite a lot of questions. Would the ISA revise have impact on key audit matters? Answer: yes. That is because ISA 701, ISA 705, 706 was all revised due to ISA 315 because key audit matter can only be derived from significant RMM. So the genesis or starting point to get a key audit matter is, in the first place, the IRMM must be significant. Okay. Next question, based on experience of auditing, what's the overall impact of the revision to this standard? Oh, that one, I can tell you, number one, no need to sleep. All right, because there'll be a lot more time and effort spent now by the auditor not performing procedure. This is where people misunderstand. People think that, because of revised standard, people are doing more sampling and all that. No. It means that auditors are now forced to think more. All right, and when it comes to thinking, right, this is where we have a problem. People don't like to think. People like to use computer to think. We like to use ChatGPT to go and tell us what is the audit risk. That's the problem. All right, so we need actually to understand that the overall revision of the standards has resulted in us becoming more thinking auditor. So as a thinking auditor, we need to spend time to do analysis. So analysis and research is where we would have to spend bulk of our time moving forward. Okay. Now, other questions. From employer's point, what is the industrial expectation in associate interns nowadays in respect of risk assessment? Many students find risk assessment a challenging one. Precisely. The current model of training, industrial training or vacation training, whatever internship, in my personal view, is not very effective. I say this because a lot of interns today, or a lot of junior staff or temp staff that come in today, are not exposed or allowed to do risk assessment process. Not allowed to. They only do execution. The risk, the thinking part, all already done before they even join the firm, or even before they join the audit engagement team. All right? Why? Why is because from the audit firm's point of view, this is the most crucial aspect of the audit. And because it's so crucial and so judgmental and so new, it is normally performed by the more experienced partner. It's normally done by the more experienced manager. They takut scared. Scared to give this to the audit intern to think about it. And it's natural. Remember, that's why I told you auditor's bias. It's a natural bias of the auditor, right? Now, that means moving forward, we see, or I personally see, that there is a need to change a bit of this method, this mode, whereby we might need to bring in the interns to directly observe or maybe even interview partners to understand what went through their mind when they assess the IRFs. Remember, we've got a 5 IRFs, CSI, ISA 240 changes. What made them throw complexity as higher spectrum risk? What made them throw subjectivity as a lower spectrum risk? We need people, the students, to understand the thought process, because while they may not be the ones who do it, at least understanding will give them some basic exposure to appreciate the thinking process as to why it works in that way. So in a way also, it means that it will go back to the old days of how we train our auditors, which means a direct one-to-one training between the partner and the intern. Right? That's one way of how I look at things in the near future. And last question over there, will future accounting graduates need to learn coding and programming? Actually, yes. The way I look at it is that some basic coding and programming would seem to be the way moving forward. And I say this not because of just the clients. I say this also because, remember, we as auditors also need to do something called data analytics. And I cannot see an auditor knowing data analytics without at least knowing Python. So a lot of auditors today, they're actually learning Python, even my own team, myself included, because the idea here is that without knowing the basic programming, how do we then design an analytical tool for the auditors to interrogate the client system, right? So that's where I think the future would be as well. Okay. I'm now going to spend the last 45 minutes of the day to cover ISA 600. All right, ISA 600 is on group auditing. Think about it again. We started today, this morning, with ISA 540. That was the genesis. We extrapolated the genesis into the guinea pig testing into ISA 315. 315 is actually risk identification on a standalone basis. Now, think of extrapolating this further. So when you extrapolate this further, you will then reach something called group auditing. And that's exactly ISA 600. The point to take note, ISA 600 is very new. It is only effective in its application this year. All right, so this 31 December 2024 financial year-end audit is the first year all auditors in the world are applying the new ISA 600. So if you have been covering group audits in your lectures using the older concept, it's okay. It's understandable because remember, it's only the first year when everybody's applying the new ISA 600. So as always, I am going to kickstart by going into once upon a time. Hari ini dalam sejarah, what have we been doing last year? All right, and how different is it this year? So before we had the change, we always knew that in doing a group audit, there is one key person called group engagement partner. The group engagement partner is the Superman of the audit. The Superman of the audit has the overall responsibility to, number one, manage the whole audit, direct, supervise, and perform the audit. Number two, make sure that the entire group audit complies with the ethical standards and professional standards of the group. Number three, render the group audit opinion. That's all interesting, logical, not difficult to understand, right? Now, in their own standards as well, ISA 600 always tells us that, oh, if you are the group auditor, you already learned ISA 315, very good. You know your IRFs, your inherent risk factors already. Now, tambah dua. All right, tambah 2 for ISA 600. So your IRF will not just be your CSI 240 and triangle. No. It also will have these two, group-wide control and consolidation process. Why? Why is because group means in IFRS 10 or MFRS 10, you're supposed to consolidate subsidiary. So when the client consolidates subsidiary, there is a process. The process can give rise to a risk. They consolidate wrongly, forgot to consolidate, or better still, consolidate and introduce fraud. Now, who's the grandfather of that problem? Enron. So if you remember Enron, Enron was the Sifu, the grandmaster that introduced consolidation process errors. All right, what's the error? Very easy. Borrow money, recognized as revenue. That one is new double entry. Debit bank, credit revenue. People debit bank, credit loan. This one debit bank, credit revenue. Why? How? Okay, let's rewind the clock a bit. Talking about Enron and how it affected ISA 600. So if you think about borrowing money, if company A borrows money, you will debit bank and credit loan. No credit revenue, credit loan. Credit loan, no good for health. Gearing increase, your what they call going concern have higher problem. So what the Enron CFO did many years ago, 20 over years ago, was they found an accounting loophole. They found a way to cheat the auditor. It's very easy. So the director, CFO and CEO went to find their gardener, driver, and their maid. They gave their gardener, driver, and maid a little bit of money to go and set up SPVs, special purpose vehicles, or in the US, we call it VIE, variable interest entity, same thing. The SPVs are owned $2 companies owned by the gardener, driver, and the maid. Okay, then they use this gardener, driver, and maid's company to go and borrow money from the bank. Now, if you think about it, no bank will lend money to a dormant company one. Banks also tak bodoh, they're not blur. They know that, hey, you don't simply lend money to a dormant unknown company. But what the Enron directors did was very smart. They told the bank, don't worry. These SPV loans will be guaranteed by Enron. So Enron guarantees the loan to the SPV. Now, the banks, when they listen to the name Enron, saliva also will come out. Because Enron at that time was the third largest energy trading company in America. So the bankers will say, wow, Enron guarantee, no problem. Lena, how much you need? You only need 1 billion. Take 2 billion, take 2 billion. We give you more. Why give you more? Because earn interest loan is as simple as that. Right? So they were lending to the SPVs money and the loans were guaranteed by Enron. Now the SPVs are not consolidated by Enron. Okay? And so the SPVs are sitting on a lot of cash. So what do? Enron then takes over the cash by selling angin, sell air to the SPV. So when Enron sells, remember Enron's energy trading, so when you sell energy or angin, auditor cannot see one. Auditor cannot touch also. So when Enron sells to SPV, they raise a sales invoice, SPV pay cash. SPV of course got cash lah. They borrow a lot of money from the bank. So they give cash to Enron, terima sales invoice, which is fictitious by the way, not real punya, is kosong punya. And then after that, Enron will say debit bank and credit revenue. And the SPVs are not consolidated because remember the SPV is owned by the gardener, the driver, and the maid. And so this game continued for a few years. And that's why Enron kept reporting super profits. Of course, profit lah. All right, got revenue, no cost. So got revenue, no cost, sure profit one. What's your gross profit margin? 100%. Okay, and then what happened is that one fine day, the bank said, I want back my money. Of course lah, loan must pay back one ma. The SPV, where got money? No money one. So what will the SPV do? They now exercise the guarantee. They tell Enron, hey, you pergi bayar balik. You are my guarantor, you go and pay back. And that's when Enron collapsed overnight. Because suddenly the amount of loan that they have crystallized on the balance sheet and it becomes bigger than even their market capitalization. So because of that, two things change. MFRS 10 and ISA 600. Right? MFRS 10 now says SPV must be consolidated. ISA 600 at that time then was amended or revised to say, hey, pergi lah check console process because you have got all these funny double entries that are being omitted from the consolidation process. Right? So Enron had a history to the revised ISA 600 by the way. What about group-wide control? Also Enron's fault. Enron is the grandfather of fraud. If you want to learn how to commit fraud, you must study Enron. That's your Sifu, by the way. So they not only borrow money and recognize as revenue, they also capitalize expenses. Very easy. Credit bank, debit PPE. And how do they do this? They do this through a yellow post-it note. You see last time we got no IT one. So when there's no IT, we have something called journal vouchers. So when you got journal vouchers, what the CFO did was he pasted a yellow post-it note onto the journal voucher and instructed the accountant, please enter this double entry, debit PPE, credit bank. All right, and so there was an overriding of control. ISA 600 was therefore revised to say, hey, you are the brilliant auditor. Please look out for this group-wide control. So the old ISA 600 was therefore like that, amended due to the post-Enron era to reflect the need for the auditor to consider the 5 IRFs plus group-wide control and consolidation process. So that means as the group auditors, we must understand component. Component doesn't refer to subsidiary only. Component includes all those SPVs that are not consolidated. So how do I know unconsolidated SPV? That's the big question mark, isn't it? Unconsolidated SPV. So just now remember SPV, IFRS 10. Unconsolidated SPV, IFRS 12. IFRS 12 was introduced to say that you must disclose, client must disclose unconsolidated SPV. So that's the starting point for the auditor. Look out for special purpose entities which are not part of the group. Okay, and how do I know this? How do I know this? Because sometimes client naughty, client don't tell you right. So how do I know this? Goes back to one of my earlier slides. If you notice over here, related party transaction. It's the related party transaction that gives you a story. Because when you notice that, hey, there's so many transactions with this party, but this party is not part of the group. This is when you got to start asking questions. And who is this person? Right? Who is this person? Will then give you another question, right? Another question, which was covered in the earlier slide as well. Ownership and governance. Who owns this related party? Because in the Enron example, if you remember, the owner of the SPV is the directors, gardener, driver, and maid. Knowing this will already tell you, hey, something is missing somewhere already. Right? And then knowing the law is the next thing. So what is the law? The law in Malaysia is actually Companies Act 2016. For those of you who are aware, sometime last year, the SSM has enforced the part of the law that deals with beneficial owner. There is something called a register of beneficial owner. In other words, if you have a $2 company owned by the director's gardener, But actually, it's owned by Enron punya. SSM will tell you in the register of beneficial owner, you will record down legal owner is the gardener, beneficial owner, Enron. So you must know the law. All right, so the law is very simple. It tells you there's something called register of beneficial owner. As the auditor, you will want to go and take a look at the register of beneficial owner. Now, if you are here, you'll be thinking, hey, Khoon Yeow, so what if the client hide? Client don't want to tell that actually Enron is the beneficial owner. Then SSM in the circular last year also said it is the responsibility of the company secretary to go and make sure that the register is accurate. If the register is found to be inaccurate, we give free curry rice to the secretary. That's right. We send the company secretary to a nice place called Sungai Buloh. Get free curry rice every day. So you notice, therefore, again as auditor, knowing the law will enable you to determine the ownership and governance, and the ownership of governance will then link you to the related parties, and the related parties will then link you to the topic that we are covering right now, which is on the identification of components. All right, so remember, components, we are not looking at the entities which are within the group. We are looking for entities which are outside the group. That's what we are worried about. Okay. Now, so when you look at group I controls, just going back one step again, we are looking at, remember, all those controls to monitor reconciliation of intra-group transactions. We are looking at things that that controls how the management consolidates the subsidiaries and equity account the associate. So from there, we will then decide, do I want to do test of control or not? Remember, test of control is not paksa rela. Test of control is suka rela. But understanding the control is paksa rela. That one you must understand. Why must understand? Because we don't want a repeat of Enron. Okay, as simple as that. So must understand. If the client has no group control, then you better tabut from the audit, because that means Enron 2.0 coming. Did we see it? Yes, it's called Wirecard, by the way. So Wirecard, another interesting case. Okay, so that led therefore to a definition of your component. And in the good old days, we say that, we are auditor, we only look at big components. Small component, tak mau tengok. All right, don't want to see. So we always look at significant component back then. So significant can be a function of size. Godzilla, size does matter. Or it's also a function of risk. Right? You can already see the problem. What's the problem? In ISA 315540, size doesn't matter. In the ISA 600, it looks like size does matter. So as you can imagine, the new ISA 600 this year will remove the size. We are all going to be based on risk. Right? But last year we are still looking at size and risk. And you might be thinking, Khoon Yeow, how do I know what is material in terms of size? Is there a magic number? So some firms have their own methodology. All right, so like for us in BDO, our methodology is very easy, 20%. Anybody who contributes 20% or more of profit before tax, for instance, will become a significant component. That's the only BDO boleh method. Different firm, different boleh method, so to speak. Okay, so that's significant component, and that means we also have to calculate group materiality to know what is significant. So you know about materiality. We talked about materiality threshold just now, 5% of profit before tax, 1% of revenue. So now when you take from a group point of view, same thing. We need to calculate back then the group materiality, the group performance materiality, and the group clearly trivial threshold. Why do we calculate group performance materiality? Well, we calculate group performance materiality because it will tell us which of the components performance materiality is to be performed at the subsidiary or component level, which will then drive the audit procedures at that level. How does it drive audit procedures at that level? Well, very easy, sampling. All right, so what is a sampling requirement? Sampling requirement is very easy. You take population divided by your performance materiality multiplied by your risk factor. Your risk factor, remember, is your DR, which is your AR over IR times CR. So your ISA 315 sudah dikautimkan here. We talk about materiality, as I told you, materiality is outside of the risk because materiality is covered under a separate component of your formula. So population is what you're auditing, revenue, fixed assets, cash and bank, trade debtor. That's the value you put in. So you masukkan population, bahagikan by your performance materiality, multiplied by your risk factor, your inherent risk factor that you calculated earlier, you get the sample size. So it's very simple theory, right? The lower your performance materiality, the more you don't sleep, because the more samples you will need to pick. So berkadar songsang, right? So in other words, sampling sizes has got an inverse relationship with your materiality. So as the group auditor, I need to calculate my component performance materiality. I need to know what is the effort that the component auditors need to do. Okay, and why is this important? Well, it's important because in the first place, component auditors might not be from the same firm. Very normal. It's very normal in practice. Just because BDO is the group auditor of Sunway doesn't mean that all the components in Sunway Berhad is audited by BDO. All right. So therefore, we might have some components audited by another firm. And we therefore need to calculate sample size and tell the component auditor, hey, you punya sample tak cukup. That's what we mean by that. All right, so component significance, therefore component materiality drives our assessment of component performance materiality, which then drives significant components in our assessment. All right, so remember, significant components do a lot of work. Not significant, cannot shake leg. If you shake leg, then you are negligent auditor. If your insignificant component, must do analytical review. So analytical review is not covered today. Analytical review is a separate standard, ISA 520. Okay. Now, remember we talked about ISA 315 this morning. Some components might be significant because of the risk. So if it is significant because of the risk, but not because of the size, then ISA 600 says you will audit based on your specific procedures. All right, take a specific, what is katakan, the risk in the subsidiary is only PPE, property, plant and equipment. Other things not material, other things no risk, only PPE. Therefore, I will design procedures only for PPE lah. For example, I will only do fixed asset citing. I will only do depreciation testing. I will only do impairment testing. I won't do other things already. That's what we mean by significant specific procedures in response to significant risks. Okay, so you will notice therefore even in the old ISA 600, there is already some spectrum of risk assessment that actually interrelates to the component auditor's competency. So if the component auditor is very competent and the risk is low, you notice you get the blue C, relax and chill. All right. But if you notice the component auditor is not so competent and the component is high risk, then you are in the hot soup. So the spectrum concept was already there even in the old ISA 600. Yeah. But then we changed 540. We changed 315. Therefore, it is only logical that we now change or update ISA 600 group audit as well. So when we audit, we change the audit for ISA 600 group audit, you will then notice that a couple of things has been aligned to the ISA 315. So for example, we align what is the audit work that we need to do. So the what is no longer driven by materiality. The what is now driven by risk. It's all based on your RMM. It's based on the inherent risk. It's based on your strategy in response to the risk. Where do we do the work? It's now not a function of significant component. So no more significant component already. In the new ISA 600, where we do our audit work is dependent on the risk. Who does the audit work? It's now no longer a function of tai chi to the component auditor. ISA 600 now recognizes that if you think the component auditor tak guna, not reliable, you as the group auditor pergi buat sendiri, DIY, do it yourself. Did we hear DIY this morning? Yes, right? ISA 540, if you remember, method C. Method C was DIY, do it yourself. So same thing here. In ISA 600, if you think that the component auditor tak boleh rely, tak guna, then buatlah sendiri, DIY. So you can already see that there is a conceptual change over there already. So the risk-based approach therefore means, number one, we are now realigning to ISA 315. Number two, no more significant and no significant components. Number three, the group RMMs is now what drives the group audit strategy. All right, so just now we have IRMM, now we extrapolate to group lah. And number four, we are now top-down approach. So top-down approach means I'm the group auditor. I'm not so bothered or worried about the component auditor. I will look at risk from my point of view, not from your point of view. Dahulu, it is more inclusive. Dahulu, we actually will include the components view to look at, hey, what did they do, and then flow it up to the group. Now no more. Now we just tell the component auditor, shut up, don't want to know. We're going to decide for you. If I tell you turn left, you turn left. If I tell you turn right, you turn right. That's the top-down approach. So ISA 600 has principally and conceptually changed over there already. So in terms of the what, therefore, you will notice over here, as the group auditor, I am the one who's performing the risk assessment process. I am the one who will apply the IRFs. I am the one who will have to do the assessment of the consolidation process. I'm the one who has to assess the group-wide controls. But you notice, unlike the earlier slide just now, my group-wide control is now divided into the control environment, the entity risk process, the monitoring controls, and the IS environment. Just pause for a moment. Have I seen this? Yes, I've seen this in ISA 315 just now. You have got your CARA over here, and you got the 4 factors over there. The 4 factors over there are actually your entity level controls. Your CARA over here are equivalent to your activity level controls. It all jives back to your audit risk model again. It's only that now we are looking at it from a group point of view, not so much from a entity level point of view. Okay, so you can see therefore it's very aligned already. No more misunderstanding, no more confused auditors already. Now, when it comes to the nature of the work that we perform from a group point of view, is no longer based on significant or insignificant component. Everything is based on group risk. And when we look at group risk, remember we are looking at a group level assessment, not component level assessment. So in other words, if the component auditor thinks it's low risk, but a group auditor thinks that it's high risk, group auditor wins. Because in the ISA 600, remember, it's top-down approach. What I say as a group auditor is relevant. What you say as a component auditor is you punya pasal, nothing to do with me. Okay? That also means, therefore, because this is the first year we are doing it, we cannot assume that the work we do last year will also be the same this year. The standard has changed. Therefore, we cannot be Sally auditor. Huh? You know what Sally? Sally is not your girlfriend. Huh? Sally is same as last year. All right, so we got Kara as your girlfriend. Sally is also your new girlfriend. Huh? So same as last year cannot be used anymore already. All right, so that means as the group auditor moving forward, we need to get our group RMMs correct in order to make sure that we don't audit the wrong way or the wrong direction. All right, boleh ha? Can ha? Okay, now, in terms of the nature of risk, that means everything is centralized already lah. So when it's centralized, that means even things like consolidated revenue will be assessed on a group-wide basis, not on a component basis. Any procedures that we do at the component level will only be a top-up. Further procedures is what we call a top-up procedure. So top-up procedure is normally because we already do group-wide procedures and we thought, maybe for that particular component tak cukup because there is a specific risk over there. All right, and that specific risk is why we design additional procedures into number C, specific audit procedures. Okay, can, huh? Now, in terms of the concept of group materiality, concept of group materiality, notice we have no more concept of component materiality. There's only group performance materiality, component performance materiality, and clearly trivial threshold sahaja. So component materiality not there anymore because we don't want to know. Remember, we are the big brother TICOR. Huh? So group auditor will decide everything for the component auditor. So if I don't like the component auditor, I can tell the component auditor, your component PM is RM1. All right, if this is RM1, that means dear component auditor, anything above RM1, pergi check. The component auditor should resign. I will tell you, gila punya group auditor. That's how it will work under ISA 600 moving forward. Okay, so these are some of the peculiarities that ISA 600 will introduce as well, which empowers the group auditor. Okay, now earlier today, you were also introduced to the concept of spectrum of risk. Same thing. In a group audit point of view, when we assess the spectrum of risk, we also have the same thing from a component and group point of view. So these are the factors that we will also consider. It's over and above the IRF. So say, for example, the client has different accounting framework. Different accounting framework, higher risk. Client is in multi-location, higher risk. Client is decentralized, higher risk. Client has got different kind of business, higher risk. Client can make their own decision at a component level, higher risk. All right. Same thing when it comes to your audit strategy. If you think that you are the component auditors are going to be only a robot, they only do what you do, then that means your engagement is still high risk. If your component auditors are included in your team discussion, lower risk. If there are many component auditors, high risk. Many jurisdictions, high risk. Why? Because you have a risk of omission. Terlupa. All right, if terlupa, high risk lah, because got so many component auditors, so I could miss out, you see. That's how we now assess our risk even at a group point of view. Right? Then where we do our work, therefore, is where we will have to look at the component information. So this diagram is to show to you parent plus subsidiary information will give you group information. But group information means that for the purpose of auditing, we must identify our component. Component tidak bersamaan with subsidiary. Component, remember, can be unconsolidated. Component can even be a shared service center. Component can also be a branch or a division. So our ISA has a bigger definition than IFRS. IFRS is only subsidiary, associate, joint venture. ISA component definition is bigger than that. So that's why as a group auditor, we are very takut that we miss out something. So when we miss out something, then that means we need to be very worried about the consolidation controls and processes. Okay, so take very simple example over here. Let me just showcase one simple example for you in determining a component. So you will notice EZ Group makes and distributes electric cars. The group comprises of 8 legal entities, including the parent, and it has operations across 3 different countries managed by a head office. And it is a function within the parent entity. So you got a parent entity in the US. Company A is in the UK. Company A has got 2 subsidiaries, manufacturing and distribution in the UK. Company B is in Australia. It has got manufacturing and distribution also in Australia. And company C is in the US. It's a management company, management co as we call it. So you can see 8 different entities, 3 different countries, managed by a head office that is based in America. Okay. Now, this means that if I am the group auditor, I now have got options in determining my component under the revised ISA 600. I can treat these 3 entities, A1, A2, and A as satu component, B, B1, B2 as satu component, parent as 1 component, C as 1 component. So I got 4 components. That's one option. Or I can, under ISA 600, say all the manufacturing component is 1 component. All the distribution component is 1 component. And then the warranty company is 1 component. The parent entity, 1 component. I can also do that. So I may end up having 4 or 5 different components as well. Very possible. So how do I choose? Is tepuk dada tanya selera. Which one is more efficient to me as the auditor? All right. So in other words, ISA 600 revised gives you more options. More options to choose from, therefore more flexibility. Okay. All right. That leads then to siapa buat kerja. Baikku. So siapa buat kerja? We have a choice. It could be the component auditor, or it could be the group auditor. Remember, if the component auditor tak mau kerja sama with the group auditor, then group auditor kena buatlah sendiri, DIY. Now, having said that, however, there's a new concept introduced in ISA 600 with repercussions as well. The repercussion here is that the group auditor and the engagement team, component auditor, is collectively known as an engagement team. It has an impact because of ethics. The ISBA Code of Ethics was amended to reflect this concept. Why? Because if the component auditor applies ethical rules, the ethical rules must be at least equivalent to the group auditor's ethical rule. So in English, kalau I'm the group auditor in Malaysia, I'm applying MIA bylaw. I have a component auditor. The component auditor is in Singapore. I must make sure my component auditor in Singapore also comply with MIA bylaw. Because I'm the TICOP, I'm the big brother. if the component auditor breached the ethical bylaw, I am the one who bertanggung jawab. I am the one who is responsible. So therefore, I have to make sure component auditor is compliant with my bylaw. Now, if the component auditor says, that's your problem, I don't want to comply with your MI bylaw, what happens? I will not rely on the component auditor anymore. I will do the audit procedure myself. And when I do with the audit procedure myself, that means I will tell the client, pay me more, because I now need to do the procedure myself. So that's the implication of the definition of engagement team. So you might see, therefore, in the Code of Ethics recently, there's a new amendment called definition of engagement team. This is the reason. Because we revised ISA 600, there is an implication even from the ethical point of view. All right, so that is why when we want to include component auditors in our engagement team, we need to assess their competency, their capability, whether they have enough resources or not, and their SOCM, System of Quality Management. Their SOCM is a function of ISQM1. It's also a function of your ISBA Code of Ethics. That is because you must remember, not everybody in this planet or on this planet adopts Code of Ethics. Not everybody. So if you have a component auditor who doesn't apply ISQM1, you have a component auditor who doesn't apply the ISBA Code of Ethics, you will notice, therefore, in the revised ISA 600, do not involve the component auditor. All right, pergi DIY, buat sendiri. Okay, so that's the implication under revised ISA 600. Now, that means also from the documentation point of view, there's a little bit of difference with the old standard, because in our audit working paper moving forward, we cannot just say, oh, the work is done by component auditor, pergi tengok component auditor punya file. That's not how it works. Anything that supports the group audit opinion must be in the group auditor's working paper. So that means a lot of the work that previously was sitting in the component auditor's working paper must now be tarik atas, brought upwards to the group auditor. And this is quite a nightmare, by the way. Why nightmare? Think of language difference. If you got auditor in China, auditor in Vietnam, pingsan. China still okay lah. We still can read Chinese lah. Vietnamese, I don't know how to read. Okay, so that one you're going to have to think about how are you going to use Google Translate in order to help you translate the working papers and put it into the group auditor's working papers. It also means that in some jurisdictions, there might be restrictions. And so the restriction can come in terms of restriction to the component auditors, component management, or even information. So the idea over here, ISA 600 also thought about it already. And the idea here is very simple. Who is restricting what? All right, so if the restriction is imposed by the component management, all right, component management, not group management. So that means you might need to ask the group management to tolong engkau, tolong sedikit, to paksa rela the component to give you the information, right? Now, another situation could be the group is only a minority interest, non-controlling interest. So in that situation, susah sedikit, right? Minority interest, equity method, equity method which standard? IAS 28. So your client only has 20% interest in another company. You do equity method of accounting. Good. So now the problem here is you don't have access to the component management. Macam mana? So ISA 600 says, well, you could try to get the information through your director sitting on the board of directors of the associate, or you need to get publicly available information. Okay. However, there could be situation where all of these still have a roadblock, jam. So in this situation, you need to consider, are you sure you still can be the group auditor? Because if can, don't accept the engagement. Withdraw from the engagement. But if the law doesn't allow you to resign from the audit, then you only have one audit opinion. Disclaimer of opinion. Right? So if we cannot get evidence, try to resign from the audit. If not, disclaim from the audit. So that's how ISA 600 simplifies and changes the way we understand group audit. And it's all because of ISA 315 and ISA 540. Okay? All right. So I've come therefore to the tail end of my sharing for ISA 600 together with all the other topics. I'm now going to go back into the questions as well in the chat box. So a couple of questions, like for example over here, we expose students to ESG and corporate governance. How should we emphasize or expose students to ESG disclosures to be audited? Well, that's going to be a very different thing altogether, because sustainability assurance is the subject matter of ISA 5000. So for the benefit of those of you who are not aware, ISA 5000 has been issued globally, but not yet adopted in Malaysia. In Malaysia, there is a committee, the ACSR committee, set up by the government, cross-body, cross-ministry, that intends to adopt ISA 5000. So the idea here is once ISA 5000 has already been adopted, you will be able to teach ISA 5000 in your universities. And that is where you see the list of procedures and methodology of how you audit ESG disclosures, right? The other thing is that I mentioned about audit technology. How can a university actually expose students to technology-based auditing instead of just teaching theory and standards? Very good question. Technology-based auditing cannot be taught purely in the university. It has to be a joint effort between practitioners and education academicians. You will need what they call practitioners to come into campus to literally share with you, showing you the technology itself and showcasing how the data is being analyzed and resulting in consequential audit procedures. That's one way. Because if you go internship, it's not going to work. Internship just doesn't work because, again, interns will not be exposed to the use of the tool. The use of the tool requires experienced auditors. So it's much easier for practitioners to go onto campus rather than the other way around. Okay? All right. I've talked about Enron's story of capitalizing expenses. Yeah, it was just a simple double entry. What they did was they put a yellow post-it note onto the journal vouchers to capitalize a lot of expenses. Yeah. Other questions. In your view and reality, how can group audit and component auditors effectively align as an engagement team requires cohesive, consistent approach? Good question. So what you notice for the last 2 to 3 years is a lot of change in auditors. So you notice that a lot of group auditors either change or the component auditors change to align under ISA 600. So it has been happening as a trend for the last 2 to 3 years, by the way. So moving forward, you will therefore see that very real that the client will have a group audited under the same firm. All right, because if it's under the same firm, then there's cohesive communication, as you have pointed out just now. All right. If a group auditor cannot get along with the component auditor, can the group auditor remove component auditor? Answer: cannot. Remember, auditors are appointed by management. So the group auditor can only go back to the group management to say, hey man, your component auditor is giving me problem. Then it's up to the group management to decide how they're going to tackle the component auditor. Okay, can the group and component have different results? Yes, it is possible. It is possible because of different risk assessment by the component auditor and the group auditor. It is also possible because of different materiality levels. It's also possible because of different accounting framework. So we have seen in practice where the component is using, I don't know, some other accounting standard. And then after at the group level, we have got a different accounting standard altogether. And you have different results altogether. Okay. All right. Another question. For component entity, would it be double taken up by 2 or more in a group? Not really. Not really, because what happens is that from the auditing point of view, what we want to make sure is we don't overlook a component. So double taking a component up is actually positive, because what you're doing is that you are double scoping the entity. All right, and that means that the risk of you missing out is very much lower. All right, it could be a bit of a situation where people are, like a Venn diagram, they are actually interrelated or integrated, but to miss them out together would be a huge risk. All right, is MFRS already in line with ISA 600? Well, not really. You see, MFRS is an accounting standard. ISA 600 is an auditing standard. They are covering two different aspects of the financial reporting ecosystem. All right, the thing about MFRS is that it will not always be aligned, because MFRS is pure accounting. Take, for example, subsidiary, associate, and joint venture. That's MFRS. But ISA 600 says we use component, because component is broader than that. Right? Take another example. MFRS has got a definition of materiality. ISA has its own definition of materiality as well, and they serve different purpose. MFRS definition of materiality is to help preparers decide what to disclose. ISA materiality is to help auditors decide sampling methods. So this is very different. So you will not achieve full convergence, but it's part and parcel of an overall ecosystem that interrelate.